Hi, everyone. You should all be able to hear me loud and clear. Put into the chat box that you can. You should also be able to see a little poll on there. If you can't, don't worry. But if you can, it'd be great. The poll asks you, what are the major problems that you face trading? By the way, you see the guy over my shoulder. That's how most people feel about trading. I've got a really different presentation this time, because what you're about to see on the next screen is the 30-odd topics I'm going to cover in the next 90 minutes. So grab a pen and paper. There's a lot of information I want to give you on this, especially if you're a first-time person to one of my videos as well. I'm just keeping an eye on some of the trades we've got going on, because I'm going to share those with you. So let's kick off. Before I do, let me just explain where all this information's coming from. Firstly, myself is 10 years as an asset manager here in Mayfair. Okay, we started an asset management company 10 years ago, but 20 years ago, I was a private investor just like you, with all the questions a private investor has, such as how much money can I make? Should I really be doing this full-time? Should I be doing it part-time? Should I even be doing it at all? How do I know what to buy, when to sell? How do I get rid of some of those big losing trades, and so on? So what I did 20 years ago when I was at university is met some of the world's leading traders. And the way I enticed them to actually even bother meeting with me, because I was only a student at university at the time, is I promised them they'd be published in the Financial Times. And then I said to the Financial Times, I've got 10 of the world's leading traders. Will you publish the interviews? The FT agreed. The hedge fund managers agreed. And so I got to meet these leading traders. I published it in a book. And those traders became my mentors, and as a result of which, I decided I didn't want to be a lawyer. I wanted to trade full-time, because they taught me a lot out of it. The FT said, would you like to do a diary about your trading? So I did that for 5 years, every single week. And that's where you're going to get the information from this. My own experience as a hedge fund manager, but also the best knowledge from the world's leading traders. Like I said, it's published and in the public domain, but I'm going to compress all of that into this 90-minute webinar so that you've got the best of everything. I want you to treat it as a one-to-one seminar, schooling, as it were, a tutorial. So ask me any questions you've got. I'm going to leave time at the end for Q&A. This way, I really want you to treat this as if we're sitting together in a room together, all right? So you've got that opportunity. I don't want anybody to leave thinking, oh, God, I didn't ask this question, didn't ask that question, or he didn't answer this, didn't answer that, okay? Like I said, let me know that you can hear me loud and clear on the chat box, okay? I want to make sure that that's the case. And that we're all good to go. And like I said, fill in the questionnaire. By the way, at the moment, the biggest questions I can see, and I'll share the results, are the biggest problem people say they're facing. The number one problem is knowing when to take profits. Close up behind that is knowing how not to be a screen slave, knowing how to handle their emotions, and then having a trading business plan is lower down in that order. Okay, great. You can see me and you can hear me. Thank you very much. I can see all of that. Let's get on with all the subject matter I'm going to cover. This is going to be a lot of text on your screen. It's going to be difficult for you to see that text on the screen, so don't worry. I'll read it out to you. This is everything we're going to cover in the next 90 minutes. I don't want anybody to leave this saying, oh, I thought I was going to get even more information. Let me tell you what you're going to get. Okay, first of all, obviously you want to know which way the US and UK and global markets are going. So I'm going to give you my insights and the insights of some of the big money movers in the markets. I'm also going to tell you which are my favorite US and UK stocks at the moment. I know I've got a global audience on this webinar, so don't worry, you're not going to be left behind, because I'm also going to explain which global funds I like as well. I'm going to show you the value growth income strategy that we use to come up with these names. There's no point me giving you names out of a hat, obviously. You want to know, well, how did you come up with these names? So I'll show you that so you can use that kind of strategy as well. And then I'm going to give you a scoring rating for every single one of the 30 Dow stocks, i.e. the stocks in the US stock market, the Dow Jones Industrial Average. It's mainly made up of 30 stocks. I'll give you a rating for all those. I said my favorite funds, or what are called exchange traded funds, or ETFs, and a quick business plan. We're going to move then from the investment side to the trading side, which is a quick business plan from the trading perspective, plus my two trading ebooks, how professionals place stop losses. You all want to know that. That comes up quite a lot. How do we hedge fund managers do it that you as private investors can do it with as little as trading with $1,000 to start off with? And how much could you make with if you only start off with $1,000? So that's the business plan. Okay, we're going to go through how much you should make on just a buy and hold for 12 months portfolio. In other words, you're just buying something and holding it for 12 months, as well as how much you should make if you're only trading one trade a day or 5 trades a week. Okay, so you can decide, should I be an investor? Should I be a trader? How much risk you will have to take in order to make each $1,000. Okay, now it's important for you to understand that relationship between reward and risk, how professionals use volatility to set those stop losses, also to set their trade sizes, and how we use volatility to get our profits. We get volatility working for us. Okay, we get volatility working for us. Got it? Then in the webinar, I'm also going to be covering a process so you're not a screen slave. How to find those entries. You know, biggest problem people have. How do I know when to get in? How do I do that quickly, efficiently, so I'm not a screen slave? How do I avoid all the psychology issues of not knowing what to do now that I've got a loss? Or what do I do with a profit? I'm scared. Should I take it? Should I not take it? Then I kick myself because I didn't take it and it turned into a loss, and now the losses got bigger, and so on. Okay, why winning traders add to winning positions, and other tips of the best traders in the world, not just from my experience as a hedge fund manager, not just from talking to 10 of the world's leading traders, but also from the 18 other books that I've written where we research what it is winners do and what it is that losers do, because we knew that's what people wanted. Okay, and why losing traders lose. 90% of private investors lose money. And obviously you can imagine that's pretty easy to analyze once you've got that kind of data from a broker, and you can work out, is it that they're trading at certain times, certain products, they're doing certain things wrong? And of course, as you'd expect, they are, and we'll go through that for you as well as the trading process. So you can trade on a smartphone or a tablet, okay? Whichever broker you like, but on a smartphone or a tablet, it's a lot easier. We're not going to have multiple screens and all the rest. It's so 1990s to do that, okay? Plus, I'll give you an insight into what a $19 billion hedge fund does and what bits of that you as a private investor can do. Obviously, there's a lot you can't do as a private investor compared to a hedge fund, but there's a hell of a lot you can. So you want some insights into the industry from that. Some of this stuff I've mentioned in my Diary of an Internet Trader column in the Financial Times anyway, but this is one good place to give you that. Trailing stops. For those who know what trailing stops are, should they be dynamic or should they be fixed? I'll explain to you the trade-off between giving space for a trade and actually getting profitability. So that trade-off between likelihood of getting a bigger profit versus the potential of risking a bit of an extra loss in order to do it. Okay, and then what to trade, what timeframes were the best, and a really pessimistic business plan. Why pessimistic, Alpesh? Well, because if we're still making ample money on a pessimistic business plan, hey, isn't that amazing? Then we know we're doing something right and it's worth adding to our income. And in this business plan, we're also going to look at, well, basically, how do we make $1,000 a month extra? It's not going to be guaranteed returns. There'll be some months when you get a winning streak, you might make 2,000. You keep the excess for the months in which you make nothing. Alpesh, what? You're one of those people who's not telling us you were always going to be winning and always making lots of money, guaranteed, just like a tap flows water. Yeah, guess what? The markets aren't like that. What we do is we have winning streaks, in which case we keep the excess for when we have losing streaks, okay? And that way we try and iron out those cycles of ups and downs and become more consistent by doing that. So I'll explain all of that to you and how we do that. Also, the best times to trade based on analysis of millions of trades, not mine, millions of trades done by private investors, and the best time frames to trade as well, whether you've got a day job or otherwise, especially if you're looking to make, like I said, about 500 to 1,000 a month extra in income, whether it's for your rent or your mortgage or whatever else. So all of those things should make sense to you. Also then, how many right trades should you be looking? Should it be all of them? Should it be 90%? There's some people out there who claim to be right 90% of the time. I tell you what, anybody you meet who claims to be right 90% of the time, they're making losses or they're lying. It's one of two things. I'll tell you why. Tell them I'll pay them £2 million a year to come work for me if they're making profit, if they're right 90% of the time and profitable, and they've got 12 months of record of doing this. They might do it out of 10 trades, but that's because they're not closing their losing trade. So their losing trade is the 10th trade, which wipes out all their gains. So we're going to show actually in a real world how often is a professional right and how much money can you as a private investor with just $1,000 account to start off with make as well. And also, how do you monitor easily these markets? So market psychology doesn't become a problem for you, but equally you capture other people's psychology into the price moves and profit from it. All right. All of this might sound difficult and complicated. It's not. We're going to let computers do the hard work for us. So we only need to be in front of the screen 15 to 30 minutes a day just to place the trade and then go. And you know what? As hedge funds, we don't spend all our time in front of a screen. We can get people to spend time in front of a screen. Why should I do it? Why would I not be better off speaking to pension funds, sovereign wealth funds, family offices, high net worths, and getting them to invest into my hedge fund? Surely that makes more sense, a better use of my time speaking to potential investors into the fund than sitting in front of a screen looking when to buy and sell. And same thing with you guys. You've probably got children, grandchildren, nephews, nieces. You've got better things to do than sitting in front of a screen. So we're going to have a whole process to make sure you're not a screen slave as well. And then how do you tell if the broker's ripping you off? Sort of telltale signs, whichever brokers you're using. I'll tell you 3 brokers I like as well in the webinar. We'll do a Q&A, and then right at the end, it's extra, it's optional if anybody wants to know, how we sued a broker for £90 million and won. But that's more right at the end, okay? Because that's an optional bit. Some people, they don't want to know all of that, and that's just more chit chat at the end. Okay, so let's get on with it. Okay, I hope that's enough information for you. I hope you agree. Yeah, okay, Alpesh, bloody hell, that's enough for us in 90 minutes. I think that's fair enough, plus all the questions and anything else that you have. All right, because I don't want anybody saying, oh, you didn't tell us enough. Anyway, hopefully you're happy with that. Put it in the chat box if you're happy. I want to know you're all happy. Okay, I want to say thank you. Like I said, there's a whole load of people from different parts of the world, not just the UK and the US. I know we've got some people from the Middle East, from Dubai in particular on this webinar. Feel free to put into the chat box other places you're from as well, my friends. Let me tell you my highlight for the week before we kick off. Highlight for the week is when CNBC's anchor, Louisa Boyce, I don't know if anybody saw this. She is the anchor on CNBC. You'll have seen it. She broadcast what trade I was doing. Alpesh Patel is doing. She put it there. Okay. I explained to her, Louisa, we had a long signal on sterling US dollar early in the morning on Asian trading. So we're buying into it, into the speech of the Prime Minister yesterday, the Prime Minister's Brexit speech. And then shortly thereafter, as Louisa's monitoring and watching me live, thank you, Louisa, she put on congratulations. You can find that on her Twitter feed if you want to timeline all of this and due diligence it and check it all. It's on her Twitter feed. So that was my highlight. Oh, Malta. We've got Michael from Malta. Great. That was my highlight of the week. Live trading, calling it right and getting CNBC to monitor it and look at it. So what made me so confident? Well, so many years of experience is one thing, but I'll show you in this webinar all the things that do make me confident. Let's start off with the investing side first, though, before we move on to the trading side. Let's start off with the investing side. And this is what the Dow's been doing. I mean, my God, this is the Dow from 13 odd years. Okay, we've got the credit crunch over there. You remember all that. At the moment, this is my view. We're going to continue riding up. Why do I think we're going to continue riding up? This is it. These are the biggest trends of 2017. Remember, I'm talking about the longer term broad brush first, then we'll get into the nitty gritty of trading strategies and so on. Trump is going to continue spending. He gets inaugurated in 48 hours. He's going to cut corporation tax for companies. Okay. And US interest rates are continuing to go up. All of those things point to a US dollar rising for the rest of the year. Also points to US stocks going up. You may well disagree with me. That's entirely fine. I'll tell you who else agrees with this opinion of mine in 1 second. Okay. UK Brexit, well, we're going to have a bias on sterling down for the rest of the year, or certainly staying around these choppy areas. But actually, we don't take a 12-month view on sterling. We trade it day in, day out, and I'll show you the trades we've got at the moment on sterling, on the Canadian dollar, and all these other currencies as well. But we do think UK stocks will continue riding, partly on the coattails of the Americans, but also because the British government is going to make sure it continues spending like crazy. Hello, Roger from South Africa. Okay. Now, who else agrees with my views? This guy. So the views I expressed about the US dollar come from Bill Lipschutz, who last year was awarded the top hedge fund manager of the year, 2016, okay, because of the performance of his hedge fund. Bill was in my first book, as I mentioned, Mind of a Trader, Lessons in Trading Strategy from the World's Leading Traders, 20 years ago. I am not plugging the book, my friends. I get £1 in royalty from every time that FT published book is sold. So I really, give the money to charity. But I'm going to give you the best bits of this book anyway in this webinar. Bill used to be at Salomon Smith Barney as global head of Forex, the world's largest Forex trader, basically, therefore, in the world. And Warren Buffett was his CEO. Bill became my mentor. And thanks to learning from him, I then moved to trading full time and setting up a hedge fund. Bill also says next year, US dollar one-way bet. And that's how he last year became the top hedge fund manager in the world. So we better listen to him a bit. Before we go on to trading and the Forex side of things, let's just look at stocks first, okay? Something in this for everyone. These are my ratings for, let's start off here, British companies, the 350 largest British companies with the highest, what I call the Alpesh value growth rating. How did I come up with that? What does all of this mean, Alpesh? Okay, what it means is we, through algorithms, look at the value of companies based on academic research, which shows that certain value metrics like their earnings, their growth of their earnings, and so on and so forth, are more important than other valuation metrics. And we want companies which are undervalued, don't we? Because if they're undervalued, surely they'll go up. But a company could be undervalued because it's rubbish. So we also look to see, is it growing in terms of its profitability year on year and its sales year on year. But even then, just because the company's undervalued and growing, whilst it might go up, how do we know it's not going to keep on falling? So we have a floor, which is determined by income. In other words, how much income is it giving me for every $100 of it that I might own, or dividends? Okay, because we know that pension funds will buy into these companies and provide some kind of a floor to their share price. So we know that we might, if we get companies which are undervalued with high growth and providing good income, they'll have a floor to their share price and probably have a hockey stick type return. In other words, they're more likely to go up than down. We then weigh each of these criteria and score them out of 10 to make life easy for us, because we want everything to be simple, simple, simple. We use our algorithms to mine the data through the accounts of all these companies over a prolonged period of time. And then we worked out that over a 12-month period, collectively, our highest rated stocks should generate us about a 25% return if we don't use any leverage. If we use leverage of 4 to 1, that's 100% return. We'll double our money. Okay, these are the highest rated British companies, 350 largest British. These are the highest rated American companies. Now you might say, sorry, whoa, let me correct that. This is the rating, this is the rating for the Dow 30 companies, the Dow 30. And you can see of those, only Boeing is a 9. Okay, the rest I wouldn't even bother looking at, because 7s I'm not interested in, 6s I'm certainly not, and so on and so forth. This over here is the highest rated British, American companies, highest rated American companies. Okay, highest rated American companies, in case you're interested. How do we use this as a buy and hold portfolio? We would look to hold them collectively. I'm not saying every single one's going to go up. I'm saying as a collective, they would go up approximately 25% over a 12-month period. If they went up more, great, we would hold on to them. If they fell more than 25%, we would turn them to cash. Those particular ones that did. That doesn't happen too often, but if it did, we would. Okay, and we'd expect as an overall portfolio to make 25% on average overall. Now you might say, hang on, you've got a number of companies which are in the same sector here. For instance, for those who know their companies, Persimmon, Barrett, Bellway, Crest, Taylor Wimpey. You might say, how come they're all in the same sector? Galliford Try as well, I believe. Isn't that too concentrated? Well, actually, since we're splitting our money between all of these, yes, you're right, there is some sector concentration, but at least it's divided amongst, 6 different stocks there. Look, it works as an algorithm for us, it works as a process for us, and it's worked for the last, since 2004, and it's been independently verified by a company called Ionic, which is the UK's largest private investor retail software company anyway. Okay, so I'm just telling you the simplicities and the scoring. The methodology you don't need to know so much. Okay, now you might say to me at the same time, hang on, sunshine, hang on, you didn't mention anything about fundamentals. Well, yes, I did. It's all incorporated in here. And you might say, well, you didn't mention charts. Well, actually, it's all incorporated in here. In other words, what we do in these scores is we incorporate the fundamentals through data mining those companies. You see, people sometimes ask me, oh, should I look at fundamentals or should I look at technicals or charts? And I say, it's the wrong question. The right question is, how do you look at all available information? That's rule number one. Rule number two, how do you decide what is important and not? Thirdly, how do you weigh what's important? In other words, you give weights to it, because not all information that's important is equally important. And finally, once you've weighed it, how do you score it? Okay, and that's exactly what we've done. Okay, the way we knew what information is important, we looked at all the academic research out of universities and so on. I've been asked about other international markets. I do look at other international markets, including India. The way I do it is through ADRs. I'm not going to talk about ADRs on this webinar because it's not meant for it, but you can do your research on the internet, or what are called American depository receipts. Okay, through those, and people will know I've picked what Tata Motors, or TTM is the code, ticker code on the American depository receipt 15 years ago, I think, you know, when it first listed, and they made a killing, people who listened to me, out of that. Now let's move on. In terms of exchange traded funds, why am I talking about these? Well, these are a cheaper way to trade. I won't go into too much detail on that. You can find out on the internet. What I want to say to you instead is these were the biggest performers over the last 3 months, and you can see the profits. Sorry, the the decimal place has been removed, but that doesn't matter. And you can see, interestingly, now some of you can say, oh, what the hell do I know about copper or livestock? Well, actually, what I'm trying to show you is it's commodities which have been going through the roof. Anything that's been tracking commodities, including rhodium. Who knows? I don't know anything about rhodium. I don't care. I don't need to know about rhodium at all, or lead. When commodities start skyrocketing like this, it's actually telling us that global growth is what people are betting their money on, or the clever money is putting its money on. Okay, clever money is putting its money on. So I just wanted to give you this as a bit of an insight, that this is, for us, is a lead indicator that the smart money is going into commodities, which tells us that growth for 2017 is pretty much assured, and at least the belief in that growth is. We can talk more about that in the Q&A. But first of all, let's get down into more of the nitty-gritty, which was the quick business plan. Okay, let's get a bit more into the trading. By the way, if over a 12-month holding of stocks, I expect to get a 20 to 25% return unleveraged in stocks that I mentioned, just buying it, holding it for 12 months, okay, unleveraged. If it was leveraged, then that would be 80 to 100% return, but unleveraged. How much should I look to get if I'm looking to place trades? Presumably, if I'm looking to trade, I'd want to get more, because otherwise, why would I just not buy and hold? And the target Bill Lipschutz said to me was we should be aiming for 100%. And I said, 100%, Bill? Seriously? No credibility, no chance. And I said, but you're global head of foreign exchange. Do you do that on your personal account, Bill? He said, yes. So he then took me through the process of how. Okay, and this is 20 odd years ago. So let me take you through that process. Okay, one thing that we started off with was just working out a really simple business plan. Okay, and this was the simple business plan we started off with. Let's say you do 20 trades in a month. Just take that as an assumption. Okay, let's just say, let us just say it is 20 trades a month. You might say, Alpesh, I want to do more. I want to do hundreds. You might say, I want to do 10. But just work with me on this, people. Okay, let's say you win 60% of those trades. And you say, Alpesh, you're supposed to be a hot shot. Why are you saying 60%? Why aren't you saying 90%? Well, actually, I'll tell you why I'm saying 60%. If we can be profitable by just being right 60% of the time, then surely when we get a winning streak or we do it even better, hey, that's great. We'll make even more money. Making too much money has never been a problem for anyone ever in the history of the world. Okay, making too little has. So let's make sure we're profitable, even if we're right only 60% of the time. Now, you might say to me, well, why 60? Isn't that high then? No, because a coin is right 50-50, isn't it? Okay, surely we're going to be better than a coin. And by the way, if you're winning less than 60, hey, just do the opposite. Okay, and then you've got a strategy as well anyway. Okay, so given that a coin is 50-50 and that's random, surely we can just tweak it a bit better. Now, if you win 60% of the time, that's 12 winning trades, because 60 times 20 is 12. If you make 45 pips, for those of you who don't know the language of trading, pips or points or pounds or dollars, doesn't matter what you call it. Let's just call it what it is for the moment. 45 pips when you win and lose 45 when you lose. Yeah, I know what you're thinking. How come you're not making more when you win? Because I'm being pessimistic. Okay, I'm just being pessimistic. All right, 45 when you win, 45 when you lose. Well, 12 minus the 8 losing trades out of 20 that you must have would mean you've got a net 4 winning trades out of 20. Okay, that means you win net 4 times 45, which is 180 points or pips. So how quickly can you make $1,000? Because that's what most people want to know. And by the way, if you can make 1,000, you can make 2. If you can make 2, you can make 4, because trading is a scalable business. It's a business and it's scalable. Okay, because it's just once you've got the skills, you can look to make more and more as you go forward. So that's not a problem. We're not too worried about that side of things. Okay, so let's just start off and keep the numbers simple by starting off with just 1,000. And that's the question that my readers in the Financial Times would ask me more than any other. How quickly can I make $1,000? Well, obviously, everyone's going to ask that, aren't they? So I say to him, well, look, let's not get greedy. What if you had 3 consecutive losing trades? Let's start off with that. Let's be sensible. All right, we're not going to promise anybody 90% winning trades like all those idiots do. Let's just be really, really straightforward and simple on this. Okay. Oh, by the way, any other questions I've not answered yet, like for instance about oil and exchange traded funds, I'll come to. Okay. Don't worry, I can see your questions, and that's great. So the question is, how do you make $1,000? And what if you had 3 consecutive losing trades? Okay. Well, if you had 3 consecutive losing trades, 45 points each, then you would have lost 135 points. Now, imagine you said, well, I only want to lose a maximum 20% of my total risk capital if I have 3 consecutive losing trades. Well, in that case, if after 3 losses you want to maximum 20% loss of your $1,000 capital, let's just say you're starting off with just $1,000 capital, i.e. $200, is all you want to lose if you have 3 consecutive losing trades, then each trade should be $1.50 per point, because because $1.50 times 3, okay, times 45, because it was 45 losses per trade and there were 3 losing trades, times $1.50 equals $200. Near as damn it. Okay. So we would bet $1.50 per pip of these 45 pips, right? So that we don't. Now you might say, well, wait a minute, what do you mean $1.50? Surely trading is done in lots or numbers of shares. Actually, it can all be translated into how much am I making or losing per point or penny or cent that the market moves up or down. But don't forget, we had 180 pips in profit in total out of those 20 trades. If those were at $1.50, then that's $270 profit in that month. Why month? Because we did it over a month. Remember, 20 trades over the space of a month. Well, you'd need 4 months then, wouldn't you? Because 4 times $270 is near as damn it $1,000, and that's what your question was. How quickly can I make $1,000? So what's the downside? Well, the downside is you get a losing streak. You can work out what your risk is to make that sum of money. That's important to know. That is important to know, isn't it? Now, you might turn around and say, as my wife said to me, wait a minute, why don't I just double my risk to 2 times $1.50 or $3 per point? So each of those 45 pips that I make on a winning trade, I'm making now 90 times 3, okay? Or let me just put these numbers down for you. $3, then, well, I said to her, you could be down 2 times 20% or 40% if it's 3 consecutive losing trades, but you'd make your return of $1,000 in half the time because you doubled your stake, so half the time in 2 months. Do you want to? You know? You see what I mean? Do you see how risk, time, and reward are interrelated? This is what people often don't realize. The more money you want to make, in the shorter space of time you want to make it, the more risk you've got to take. But that's a risk you may be willing to happily take. And if you are, fantastic, great, no worries. Do you see what I mean? But you're an adult. It's up to you. Okay. I just want you to know this. Some of you say, no, that's too much. I don't want to trade that larger size, $1.50. I would rather do half of that. That's fine. It is a matter of taste and judgment for each individual person. Okay. But at least you should understand the facts and the numbers and how we arrive at them. Okay. That's what I wanted to get across to everybody on this. Okay. Now, moving on, because there was 30 things, remember, I had to teach you in this. One of the critical things is if you can make $1,000, you can make two. If you can make two, you can make four. Why? Because the skill is the same whether you're running $1 billion hedge fund or trading with $1,000. Okay. One of the other things I promised, the 30 things I promised you today, is if you watch to the end, I will make sure everybody watching to the end receives 2 free full trading books, ebooks, electronically, digitally. Now, why do I give you an incentive to watch to the end? Well, it's a bit like a personal trainer who says, listen, if you go training in the gym, you can eat a chocolate. I know I've got to motivate you. What else I'm going to ask your permission right at the end in the final 10 minutes, and you don't have to stay for the final 10 minutes if you don't, is if I promise you all this great content, do I have your permission in the final 10 minutes to tell you what my hedge fund is doing in technology? Okay, what it's doing with financial technology in the world, how we are innovating. Okay, because I want people to know how we are an innovator. If I have your permission, please put yes into the chat box. I want people's permission because I don't want people to say, hey, you gave me 30 pieces of great content, but right at the end in the last 10 minutes, you bastard, you talked about yourself. I hate you. I hate you. This is what sometimes happens. Like, you wouldn't believe it. You give people great content for ages, and then last 10 minutes you talk about yourself a bit and they go, you're narcissistic, egomaniac. Okay, thanks, Michael. Thanks, Richard. Thanks, everyone. Okay, now let me tell you how it all started. What you're going to learn today is the humble truth. All right. The humble truth is this is how trading used to be for me. That's not actually me. I've still got a little bit of hair. Okay. But this is how it was for me. I wasn't born out of the womb a great trader. All right. By any means. I had to learn it by getting mentored by people like Bill Lipschutz, David Kite, all the people who were in my book. They taught me and I had to find a way of meeting them as mentors. Okay. And getting that education from them. And the book was the way I thought I would do it. Gandhar, absolutely. I apologize for swearing. You're absolutely right. I've got a big enough vocabulary with that, but I'm not kidding. People get that annoyed. I apologize, sir. Thank you on that point. Now. This is how it used to be. So I just want you all to know, wherever you're starting off, okay, I want you to know I used to at university as a side job clean toilets. All right. I don't want you to think, oh, he must have been born with a silver spoon. We can't do anything. You might not all want to set up hedge funds. That's my offices now. I don't own the whole building or anything by any means. We have a little office down there. Okay. Our boardroom. You've seen me as CEO on here and all the rest of it. Well, actually, I grew up in a small part of Leeds called Armley, which is one of the poorest parts of Leeds. So I don't want anybody thinking, oh, well, it's easy for you, mate. Your daddy was probably a fund manager. No, he used to deliver cars. Oh, your mum was then. No, she used to be a nurse. Okay. So I want people to know what I'm teaching you is teaching you what I learned from scratch, not because I was some insider trader somewhere, learned it from scratch. And what got me into trading was figures like this. Okay. I could have been a lawyer, and lawyers make a lot of money, and I trained up as a lawyer. But what it was, I saw that all these hedge fund managers had so much bloody money. Okay. And I thought, you know what? I don't want 80 million. I don't want 4.5 billion. I don't want 68 billion. Don't get me wrong. I'd love if my hedge fund had those kind of sums under management. What I wanted was, I thought, bloody hell, even if I get 1% of theirs, I'll be happy. I'll be happy. You know, especially when you read about hedge fund managers like Michael, who turned $30,000 into 80 million. Of course, you're going to get interested, aren't you? And I thought, well, if they can do it, why can't I? Everybody's got the right to pursue, you know, nobody's got the right to be guaranteed, but at least the right to pursue. And that's all I wanted. I wanted to do that. So let me just, for those of you who might not know, just give you just a quick primer on how trading works. Okay, we get a signal. I'll explain how we get signals. That's a down arrow, which means we expect the market to fall. Now, this is an example from sterling yen. Now, you might say, oh, I've never done currencies. What the hell are you talking about currencies for? Don't worry. The principles are the same, and I'll explain why currencies are safer than stocks in a second. Okay, so let's say when we got the signal, and I'll explain how we can have a strategy to deliver signals. Okay, it was 185 yen. Okay, and then it fell all the way down there to 165 yen. So it fell 20 yen, or in the language of trading, 2,000 points or pips. Okay, it doesn't matter that that's 2,000, that it's called 20 yen or 2,000 points pips. The principle is always the same. And if you traded in whatever number of lots or spread betted or did CFDs, whatever it is, or futures, doesn't matter what, and we'll come to that in a second. How do we do all of that? Because I know a lot of you are beginners. Let's say it was $1 per point. Okay, well then that's $2,000 in profits, isn't it? Okay, $2,000 in profits in 2 months. Okay, in 2 months, because this took 2 months for the price to reach down here, and $1 a point at 2,000 points. Now, if you're intermediate level, i.e. consistently profitable and have the capital, you might do $10 a point, which case that's $20,000 profit. Now, my job is to get people from being beginners to intermediate. Incidentally, expert level, who'd look to make a lot more and trade $50 a point, that's nobody on this webinar. Those are the investors in my hedge fund, people like Tom Singh, who's an investor in my hedge fund, the founder of New Look, or the founder of Cobra Beer, Lord Billamore, in my hedge fund. They're the kind of people who are going to do those kind of trades, okay? Huge, big size. Nobody here is going to do that. We're going to start off just being beginners. We'll look to do $1,000 or $500 a month. We need to know the skills. The other thing I'm going to make sure you all know is, yeah, there's a lot of brokers out there offering lots of complexities and binary options, and our website does this, whiz bang, all the rest of it. Forget it. It's really simple. All it is to trade simply is this. That's all we all want to know. Okay, you just need to know when to buy, when to sell, where to put a stop loss. For those who don't know what that is, I'll explain it. I know most of you do, so don't worry. How much risk to take and where to take our profits. That's all you need. You need the order ticket. That's all you need. Beyond that, when brokers, we'll tell you market sentiment, we'll tell you this, we'll tell you that, forget it. They're just trying to market to you something new. It's as simple as this, and we're going to keep it bloody simple. One thing you're going to learn about making money is it's too simple. People make it too complicated. Okay, it's simple, but it's hard. All right, so don't worry. Don't think it's so simple that how come everybody isn't doing it. I'll explain why people keep getting it wrong by making it too complicated. Okay, and it's not my word you've got to take. I'm actually going to show you actual strategies from inside a hedge fund far bigger than ours. I'm going to show you the inside strategies from a $19 billion fund. And by the way, I'm going to do it by showing you the slides I've stolen from them. All right. Okay. So you don't have to take my word for it at all. My fund isn't that big. Mine is only 100 million euros. I've put dollars there, haven't I? 100 million euros. In other words, other people's money, not mine. I don't want you to think, oh God, you're stush, mate. No. Other people's money. We only earn fees on it. That's what all funds do. Okay, so we're tiny, we're pathetically small, but I have ambitions, hopefully. It took me 10 years to get to that, you know, and maybe in another 10 years, we might get to bigger. But anyway, I just want you to know that simple is what you're going to do. I better give you a disclaimer. Okay, the disclaimer slide should have been a bit earlier. That's my fund. We're authorized, regulated by the FCA, well, the FSA as it used to be, and that's the disclaimer. I don't want anybody to go off from this webinar saying, I blew my head off, Alpesh. Okay, don't do that. My offices and contact details in case you ever need to get hold of me, should you happen to be in Singapore. I'm going to be there March 21st, by the way. Okay, so there you go. Now, let's get back to the trading part. You know, trading, when you look at a price at 100, it can only do one or two things, can't it? It can either go to 120, okay, or it could go to 80, right? Let's just simplify a trading strategy for ourselves. Let's say you did 100 of those trades, and let's say you just tossed a coin. And so 50 trades went up 20, and you made $1,000, and 50 went down, minus 20. You lost $1,000. Your net return would be zero. It'd actually be a little less than zero because of the bid-ask spread and any commissions you might pay. And we're going to look at how to make sure we keep those costs down as well in a moment, my friends. All trading is about is just trying to tip the balance slightly in your favor, not trying to do too much, but just trying to get maybe 60 instead of 50 right, and therefore 40 wrong instead of 50. All we're trying to do is do a tiny, tiny difference. Well, that tiny difference makes a big difference. Means net returns would then be $400. Okay, would be $400. That's a huge difference, isn't it? From just a small edge. So my job is to make sure, how do I make sure you get more of these, not 90%. Hey, and if you get a winning streak in the right 90%, fine, you'll get more money. And how do we make sure we limit this to only 80 and don't get a bigger one? And that we get a few fewer of those. That's all it is. I know I make it sound simple, but that's because people often forget how to simplify it, and that's how they end up bloody losing money. And the other thing we're going to do, before I show you the live trades and the trading screen, is you're going to trade on a computer, a PC or a laptop. You're going to get your signals there, okay? PC or laptop. So write that down. You're going to spend about, well, I'm going to tell you how many minutes, but 15 minutes minimum a day. It could be more if you want, but at least just minimum 15. And then next to your PC or laptop, you're going to have your smartphone or your tablet, and you're going to place the trade on there. Why are you not placing it on your PC? Well, I just think it's easier and more beautiful to place it on these things instead. So this is your broker on your laptop or your PC. Sorry, your laptop. Start again, Alpesh. This is your broker, okay? B for broker, on which you're going to place your trade, whether to buy or sell. Right, and this is where you get your signals. S for signals, okay, on your PC or a laptop through a trading strategy, and I'll give you a strategy which you can follow yourselves. Okay, that's how we're going to make it simple. Before we go into the strategy and the business plan, we need to know why the hell, in that case, Alpesh, does trading look like gambling to 90% of the people who lose? Yes, I know you're shocked. Alpesh, you told us 90% are losing money. Why have you even brought us onto this webinar? Hey, why have you done that? I'll tell you why. I'll tell you why. We're going to get into the 10%. Surely for all my bragging about that I'm good and all the rest of it, I should be able to get you into the 10% of winning traders, shouldn't I? Let me tell you what Bill, as in Bill Lipschutz, said to me about the difference between traders and gamblers. You see, a trader, and I'm going to talk through this because it's so important. Some of you might think, just give us the bloody strategy. No, because it's more important you understand everything behind it. Otherwise, you won't follow it, okay? Traders trade small positions. I know, it's hard to believe, but that's what the world's leading traders even told me. Gamblers trade big money relative to the capital they have. Traders do a lot of small trades. They'd rather do more small trades with small capital and put a little bit into the bank each day than try and do a few big trades for obvious reasons. They're not gamblers. Traders follow the trends established in the market. They don't try and create a trend. They're trend followers, not trend setters. Got it? A gambler tries to be a bloody trendsetter. They step in front of the market and say, oh, this is what's going to happen. Theresa May's going to say this. She's going to say that. You know how CNBC yesterday promoted my trade and congratulated me for getting it right? I didn't tell them what Theresa May's going to say. I openly even told them, we got a buy signal, 5 a.m. from the Asian market trading, so we're long on sterling. I even said the trend was already set. I even said I copied my answer from someone else. Yet, guess what? I get the congratulations and get to be made to look a hero on Twitter and on CNBC. I didn't set the trend. I didn't try and predict. By the way, if anybody looks at my LinkedIn, you'll know that I am connected to the Prime Minister's speechwriter, but that's not how I knew what was going to happen. Didn't know at all. I don't want to try and guess what the bloody Prime Minister is going to say. I want to follow a trend. Okay, and that's what we do because life's simple, and I'll show you how we follow trends. Also, traders never add to losing positions. There is not a single professional trader in the world who adds to a losing position. Okay, write that down. Losers add to losers. Gamblers add to losing positions. Losers add to losers. Traders start small in size in a trade, and they add to it if the trend makes it more profitable. Gamblers start big and take bloody small profits. That's ridiculous. Sorry, I keep saying bloody. I really am sorry. Okay, they start big and take small profits. That's why they're gambling. You know, people say, oh, all markets are gambling. And I say, yeah, if it was gambling, how come there's $450 billion of assets in trend following hedge funds? You'd think somebody would have worked out it's gambling and pulled their money somewhere else, wouldn't you? Okay, it is gambling for 90% of people because they're doing it wrong. They're doing it wrong. Okay, traders place a stop loss just outside the range of market noise. I'll explain what that means. So they clearly know when their strategy is not working. A gambler will have no stop loss, or it'll be so far away, they'll end up suffering some really big losses. A trader, okay, if they have a string, not strong, a string of losing trades would not impact much on their account. Whereas a gambler, if they even have 3 losing trades, they might be down about 50%, okay, just from 3 losing trades. Now, tell me, okay, don't worry, other people can't see. Put it into the chat box. Is what you've been doing up till now more the characteristic of a gambler or more the characteristic of a trader? Feel free to put it in the chat box. I won't say your names. Okay, I won't send the information to your spouses, but wouldn't it be interesting to know whether you're behaving more like a gambler or a trader up till now, my friends? So like I said, one of these traits, we're going to make sure all of our traits are going to be trader-like in this webinar. And one of them, like I said, is we're going to be trend following. And you know, in case you're thinking, well, why should I be bothered to trend? This is actually from the Financial Times. Trend following hedge fund strategies lead performance in 2016. We're going to make sure you learn some of these strategies and you're trend following. Well, your next question is, well, where? But hedge funds never going to tell us if they're all making that much money. Oh, I anticipated your question. One of the biggest hedge funds in the world has released a video to demystify how it makes money. AHL, $19 billion. Okay, on demystifying how it makes money. So I've done that as well, all right, for you. So how do they do it? These are the slides or images I've stolen from a $19 billion hedge fund called Man AHL. So let me just tell you some of the ways in which we follow trends and then show you a business plan of how much you should be looking to make and how you can follow trends as well. And this is ridiculously simple. This is a $19 billion. I mean, obviously they do a lot more than this and more complicated stuff, but it starts off with this simplicity. The price over a period of time is going down, 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 then it starts going up. Now we've got to decide, is it going to keep on going up? In other words, we go long. In other words, we buy at this price low and we sell high. Or is it going to continue going down again? Okay. In which case we go short. In other words, we sell at that price and buy cheaper again. Now, my wife asked me, how can you sell something you don't own? I said to her, don't worry about it, darling. You can. You just can. Okay. So are we going to buy and then buy low, sell high, or are we going to sell high, buy low? That's all it is, long or short. On that, how does a hedge fund work this out? Well, what they do, this one in particular, is they'll look to see how long has the trend been in place. And every time it's been downwards, they'll put a minus sign in. Okay, this is a simplification, obviously. I'll give you the actual strategies in a second. And if it goes up, they put a plus. And then they may as well, when they're looking at those trends, count them up, -1, -1, -1. There's been so many sort of minuses. And if they're all minuses, they'll say -2. Okay, they'll do it for different types of trends. And they'll say, well, 1, 2, 3 minuses and a plus. Well, what's 3 minuses and a plus? It's not on there. Okay. And what they'll do is if it's 4 minuses, we'll go fully short. If it's 4 pluses, so the trend's just been going upwards and upwards, we'll go fully long. And here's the intelligent thing. This is the clever bit people don't get. And that's why it's circled. When it's a mixture, which is what it is most of the time, so it's a minus and a, sorry, there we go, -1, -1, -1, and a +1, which is what we've got on screen, they'll take a smaller short position. In other words, smaller trade size. And then they'll increase it as and when the trend goes in and becomes stronger. What an insight. What an insight. Well, actually, it's not. For us in the hedge fund industry, this kind of stuff is just straightforward. This is pretty easy stuff for us. Okay, my friends, this is pretty easy stuff for us. So I'm going to show you, well, now this shows you how we find strategies. I'll give you actual strategies. Don't worry, this is too generic. That we look to follow trends, how we find them, how we start off with a small position, and then we add to it and make it a bigger position later. Okay? Now, why did I keep on banging on about Forex? Well, the reason I talk about foreign exchange is this. The foreign exchange market's $5 trillion a day market, whereas the stock market, it's a stock market like the New York or the Tokyo stock market or the London stock exchange is tiny. All right, I prefer foreign exchange because it's, well, I'll tell you the reasons why. It's safer than trading stocks, and I'll tell you why. First of all, there's no commission, so it's going to save me money. There's no middlemen. You can trade Forex. You're just buying, you're matching buyers and sellers like an estate agent does, although some brokers don't do that, in which case we avoid them, and I'll come to that in the broker section of the webinar. Okay. there's lower transaction costs, because when it's a $5 trillion a day market, guess what? There's lower transaction costs. You can trade, like I said, 24 hours a day, 6 days a week. No one can corner the market. Some people, naughty people like Deutsche Bank, might for a second or two try and push the price up. Fine, we'll just follow their trends and ride them. And they're trying to push the market up. They can't corner it for any prolonged period of time because it's $5 trillion a day. Nobody's got that kind of money. Okay, leverage, well, that's a double-edged sword, doesn't really matter. Liquidity, like I said, it means, well, for you as private investors, us as a small hedge fund, we don't have a problem placing trades when we want, as and when. Okay, there's low entry barriers, and here's the one I want to show you. There's free platforms. I never want you, and write this down, to pay for anything every day, every week, or every month in subscription costs, whether it's data, okay, to monitor the markets, or software to see that data, okay? I want it to be free. And as I said in my FT, I show people how to save money all the time. So I'll come to that in a second. And Forex gives you that. Stocks doesn't give you that. Stocks gives you hardly any of this, actually none of this. So it's more expensive. And we don't have to use the leverage that Forex has. In fact, don't use it. Use it as little as possible, in which case you'll be outsmarting those people, because you can be having a full-time day job, and at 3 a.m., if you feel like trading Forex, you can. You can't do that with stocks. Something happens, you can at least be in and out of Forex. You can't do that efficiently with stocks. You end up lumbered with big fat costs. So you end up instead with stocks buying and holding over a 12-month period, which is fine because you get your 20% in stocks if you want. What I'm going to talk about is how do we trade instead and get more money, do 100%, or ideally do both. Do a bit of stock buy and holding and trading on the Forex. Now, which are the important numbers? I want you to write this down. I'm going to show you a process by which I think you should only be spending 15 minutes minimum, at least 15. You can spend more if you want, per day. I want us to be looking at 12 products to trade. Well, actually 12 to 16. And I'll show you the screen in a moment when we see the live trades. I want you to look at one computer screen, not 6 or 8, like some people tell you. No, that's not realistic. It's not how it's done in 2017. We're going to try and do one trade a day, and you'll see from the business plan why. That's minimum. You can do more if you want, but I think one trade a day is ample. So it's 20 a month, okay? 20 trades a month. Typically, what is it going to look like? How are we going to do this? Let me show you some more numbers of what I want you to look at. We're going to trade currencies which are major versus minor, or, well, look at it on screen, minor versus minor, okay? And I'm going to tell you which time frames I find the most lucrative. There's 2 sets of time frames I find the most lucrative, either when the market's open in the major financial trading centers of the world, which are London, Tokyo, New York, so between 8 a.m. and 10 a.m. there, okay, because that's when the markets tend to move the most in our experience, my friends, in our experience. Okay, so that's the first thing. The second thing is after 5 p.m. UK time, when the big banks go home, because London is the overall financial trading center for Forex, what we find is that the trends are a bit easier. Why minor versus minor or major versus minor? Because the banks don't tend to trade those currencies as much. Therefore, the trends are narrower. The trends are easier. They're less volatile, okay? Therefore, the trends are less volatile. And I'll show you what positions based on these rules we've got open at the moment. Now, I'm not saying you should only trade those currencies, and I'll show you how profitable each of these currencies is and isn't according to data, not just from our trading, but actually general market data as well. What I want you to do essentially is, well, my favorite time frame is the 1 hour time frame on bar charts, but you don't need to just trade those. Essentially, I want it to be set up to look like this for you. This is free. Okay, this software that you see, look, demo. Demo doesn't mean it expires. Demo means that even on a demo account, you can, from multiple brokers, okay, get software like this with live real-time data in foreign currencies, gold, oil, indices, and so on. Live real-time data free for life, okay? And to prove it, I show people a demo account, because sometimes people say to me, oh, but if it's your account, then surely it's because you've got special privileges. No, and this is for private investors. Hedge funds don't trade through this kind of software. This is for private investors, so it's geared towards you. There's no one telling you stuff you can't do, okay? So it's stuff you can do. Now, why am I looking at 12 different screens? I want you I told you the figures a moment ago, and I hope you wrote them down, 15 minutes a day minimum, to scan these 12 to 16 windows in the currencies of your choice, but I told you which ones I prefer, and these are the ones we're looking at the moment, in a variety of timeframes, because that will A, maximize your opportunities, secondly, allow you to hedge. So even if you've got an Australian dollar position, 2 different ones, at least it's not all your money in there. I only want you to do 1 quality trade a day though. Okay, just pick 1 of these. Now the question is, well, wait a minute, how do I know when to trade, what to trade? Well, we'll come to the trading strategy, but we put our strategy, we make it simple. We just have it show us on the computer screen an arrow, which tells us when to enter, when to exit. Okay, so we're short at the moment on euro dollar. By the way, each one of these bars is euro dollar. I don't care whether you use Japanese candlesticks or not. They're probably easier to see. Euro dollar 30-minute bars. How did we get the entries and the exits? I'll come to that. We are short on this. You can see it there. You can see that we had a tiny little profit, nothing to write home about on that a couple of days ago. And then today's been great. From the moment we got in the office, we had this long a rally upwards. I say today, yesterday, which exited late yesterday as well. And now we're short on this one, which, as I said, is euro dollar. Okay, we're short on it, but we're not making money on it. Alpesh, you're showing us a losing trade? Yeah, because you can see it's short, but it's just into that territory. So the questions arise, well, how did you know that to go short? Why is there stop loss there, i.e. SL, stop loss? And what's all of this? What's all this add 1, add 2, and these indicators telling you your confidence levels of whether it's going to fall or not, and so on? We'll come back to this one because I'm pretty confident it's going to fall. Okay, Australian dollar, Canadian dollar, 2 minor currencies. Yeah, well, look at it this morning. Okay, we got the buy signal. We added an additional position here where the first dotted line is, another position there. Okay, and it's been great for us. It's just been stonkingly great. But hang on, the market was going sideways beforehand. How come you haven't got a lagging indicator? Let me tell you something good about trading, a good trading strategy. And by the way, this is Australian dollar, Canadian on 15-minute bars. I don't like 15-minute, but on a webinar, they move more, so it's easier to display trades on 15-minute bars. Okay, what you see here on any good, decent trading strategy, it should give you a window of opportunity in which to enter, ample time. Okay, like this does before it moves ahead. So you don't have to be screen watching. That's why you can afford to watch for 15 minutes a day, because even in the first, whatever, half hour of this webinar, like I showed you earlier, we got a sell signal there. Look, and it's coming down a bit. Come on, come on, come on, come on. Force it lower, people, on this webinar. Come on, will it lower? Do it like that Uri Geller guy. Don't worry, it'll drop. I'm sure it's right near there, kissing the entry price, about to turn from loss to profit. Come on. We'll come back to it. Sterling Australian dollar, this has been exited, and you can see it up there. Okay, we're going to come back to some of these trades. I just want to show you what we've got at the moment. This is sterling Canadian dollar 30-minute bars. Now, obviously, sterling moved a fair bit yesterday, as I showed you on CNBC. I did that one live on air yesterday, but we're going to come back to some of these. The principal figures are these. To maximize our opportunities and hit our profit targets, we need to maximize our opportunities by looking at multiple indicators across multiple products across these figures. Okay, these are my favorites. All right, you don't have to do that sort of in stone. You only look at those currencies. As you saw, I look at other ones as well, but I'm just telling you what we like as a process. We find the easiest. Well, what about times to trade then? I hope you made a note of all of this, by the way. Okay, what about times to trade? Data, not from us, from a major broker, which was then published in one of my books, was this: the likelihood of trader profitability by hour of day. Okay, and this happens to be in sterling US dollar, but the principle applies, I believe. And this was the time frame they analyzed this data. What they found is that trader winning percentages were higher at these times, and this is New York time. Now, some of you might say, I don't live in New York. What's my local time? Okay, well, Google it. If it is 3 o'clock in New York, what time is it in London? 8 o'clock. Okay, if it is 6 p.m. in New York, or 7 or 8, what time is it in London? Well, London's 5 hours ahead. It's 11 or midnight or 1 a.m. in London. You say, well, I'm not going to trade those times. That's fine. You don't have to. I'm just telling you which ones they are. Okay. as well. Okay. Alexander, yes, I'll do that. I'll also what I'll do, Alexander, let me just send you a reply right now. If you look at, well, actually, I'll just send it to you right now, because I did send you an email, Alexander, on all of that. So please have a look on that, and you should be able to see that email link. Okay, so these were the timings. Now, I'm not saying it's cast in stone. I'm just saying this is what statistically we found. I'm not going to give you some kind of big theory as to why either. It's just statistics. Our job within the fund is to know what the hell's going out there in the big wide world, okay? And as a result of that, to make sure that we're on the back of it and we're succeeding as a result, all right? Now, let me tell you something else. This was across millions and millions of trades done by a major US broker. And this is what their private investors, such as yourselves, were trading in currencies, and how often, what percentage were winning and what percentage were losing. Sorry, I know the screen resolution can be a bit small on there. The screen resolution might be a bit weak, okay? But continue with it, right? I'll explain. So Australian dollar, New Zealand dollar was the one in which their clients were most likely to win. 71% of their customers had winning trades in that, okay? And Australian dollar, Japanese yen, only 49% did. Let me tell you something, and this is across millions and millions of trades done by a major US broker. Let me tell you something. Even though their clients were doing 71% winning trades in Australian dollar, New Zealand dollar, the clients were still losing money overall. Only 10% were profitable. So you might say, huh? How does that work? How can only 10% be profitable, yet they've got so many winning trades? What was happening is when they were winning, they were making, let's say, 10 points. And when they were losing 30 points. Do you see? Do you see? By the way, some people, I think they might not be able to get back in or whatever. Just refresh screen if you've been logged off for any reason, if any problems. Okay. Now, let's go back onto this. Okay. What was actually happening, my friends, is this. They were losing too much money when they were wrong, and they were winning too little when they were right. So how do we avoid that problem? How do we, because look, private investors can clearly call it right. Virtually every single major currency pair out there, they're calling it right more often than they're wrong. What they're getting wrong, though, is they're winning too little and losing too much. Okay, so how's that happening? What the hell's going on? Let me explain what's going on. This image sums up trading and the most important parts of trading. Imagine you've got a buy signal. Okay, I'll tell you how we get the entries in a buy signal next. Okay, let's say you've got a strategy which tells you how to follow trends and get on the coattails of them. Okay, and let's say, therefore, you're going to buy here. Okay, you're going to buy that. Some of the most important pieces of information I can give you about what hedge funds do is this. We set a stop loss to make sure we don't get big losses, so we don't end up like those people who lose too much. So how do we set a stop loss? We know we need to set one. How do we set a correct one? Well, a stop loss is something which gets you out of a trade, even at a loss, if the trade isn't going your way. How do you decide if a trade's going your way? You make sure you put a stop loss at a sufficient distance that clearly, if the price goes to it, it shows that it's not going to go in the direction you thought it was, which in this case was up. Because if it's going all the way down here, it's clearly not going to go up. So how do we still work that out? Well, you can do it through experience, or some people will do it by looking at the market volatility. What does that mean? Okay, pay attention. This bit can sound a bit confusing, but it's not. What you first do is you say, well, look, if I put the stop loss outside of market noise, far away from just the market noise, then surely it means that I'm not going to get stopped out by market noise, which I don't ever want to do, but it means my strategy is probably not going to work if it moves that far out. Okay, so how do we determine then market noise? We look at the length, i.e. how much it's moving up and down in the average of the preceding 14 periods. Now, at this point, you might say, oh, but I'm not going to do any of this. This is too complicated. Don't worry. The computer's going to do it for you. You're still going to be in front of the screen for 15 minutes a day. That's all. The computer's going to do it. But I need you to understand what computers do and how you can get the computer to do it, okay? So we look, say, over the previous 14 periods, the average was it was moving up and down 20 points every day on average. So we might say, well, if it moves, therefore, 60 points, okay, then that means that my trade is not being just moved by market noise, but it's actually changed direction. It's never going to go up. So I'll get out. For those who want to know how to measure all of this, you can look for it on the internet. It's called the average true range. It's one way. It's not the only way. It's one way. Okay. It's one way. And that's 3 times the average true range, or the ATR, for instance, or you might do 2.5 times. My point is not that. My point I want you to understand is this: a volatility-based stop loss, secret number 1, volatility-based stop loss is one of the critical ways in which all hedge funds protect the downside and make money. What they therefore do, and what's ingenious about it, is this: every stop loss is therefore bespoke to that particular market trading condition, as it should be. And guess what's ingenious? The more volatile the market, the further away your stop loss. Isn't that clever? So the more noisy the market, the less likely you're going to be hit by noise. And the less noisy, also the less likely you're going to hit by noise, because the stop loss is closer. At which point you might ask me, well, surely if the stop loss is further away, you're going to lose more money. No, because secret number 2 is volatility-based position sizing. What does that mean? That means if the market was twice as volatile, so instead of 20, it was moving on average 40 points here on average, then our stop loss wouldn't be 60, it'd be 120, 3 times that, i.e. twice as far. If it's twice as far, our position isn't, say, £1 a point, which is what it was when it was a 20 stop loss. Our position size would be half of that, 0.5. So we still don't lose more money. If the stop loss is twice as far, our position size is half as much. Simple as that. In other words, and here's ingenious, volatility-based stop loss means volatility-based position sizing. So every trade is bespoke to the volatility conditions of the market, and we don't risk more money. If the market's more volatile, our risk is still the same. That is what every single successful trader in the world does. However, you still don't know how we got these entry levels. Well, to follow the trends, I'll come to that, and how we look at market psychology to do that. And a computer can calculate all of these stop losses for us in 3 seconds. So that's not a problem. Guess where we put our profit target? If we want to be a beginner, we put our profit target on the opposite side as a mirror. Okay, up here on the plus side. Let me just clean the screen, okay? So we put if our stop loss is here, and this was, say, 40 points away, our take profit would be 40 points. Now you might say, why isn't it further up, Hedge? Why aren't your reward greater than yours? I'm just saying, as a beginner, you do that, okay? As somebody who's more advanced, degree level, you wouldn't take your profit there. You'd add to your position. So let's say you'd started with a position size of just making £1 for every point it moves up. Here, you'd add another £1. Why? Aren't you risking more money? No, because your stop loss by then will have moved up, because it's a trailing stop loss, remember, will have moved up to break even. So when you add another position of £1 here, and you got your first one here, you got your profit here of £40, and you've added another position. And as this moves up, guess what? You can do it again if you want, but winners add to winners. Every successful hedge fund in the world, winners add to winners. Winners add to winners. It's as simple as that. Okay. However, as a beginner, you don't need to do that. As a beginner, don't do that. Just take your profit quickly. Okay. Just take it really quickly. I want to keep things simple for you if you're a beginner. When you get more advanced, I teach and mentor you to be more advanced and add to your winning trades and ride and run them. Okay. The way we ride and run some of ours. Okay. Let me just show you where we were on, whoops, where are we? On that one. Oops, I've not shown it on the screen. What an idiot. Here we go. There we go. Remember I showed euro dollar 30-minute bars earlier? So look, we got the buy signal. Okay. We know when to add to I mean, that's showing for these because it's showing the latest signal, which is short at the moment. But we know when to add because the screen tells us add at these, and then when to exit. The X means the momentum's run out. The initial conditions which led us to enter the trade have now no longer apply. They've run out, therefore exit. Okay, so it is simplified, but the point of it is this: we're letting the volatility generate our profits, because just as the volatility is giving us the risk of losing money, so the volatility is also generating the profits for us. Now you might then turn around, well, wait a minute, how much are we looking to make on all of this, and what is our risk? Let me just explain. Give me 1 second. Oh, by the way, that's my mum. She always makes an honorable appearance in every webinar. I apologize for the use of the word rich. I'll give you the business plan, then the trading strategy behind it in a second. The reason I use that is one of my hedge fund investors, as I said, Tom Singh, the founder of New Look PLC, said to me, how come you're not rich? And by that, he meant, how come you've only got 100 million euros under management, not $1 billion? And I said, I agree, Tom. It's frustrating for me as well. I agree. Okay, I think we've done well in 10 years to get to 100 million euros, given that we're competing against Goldman Sachs and JP Morgan and everyone else. And who would you rather give your money to? Goldman Sachs, obviously, or JP Morgan. Everyone wants to save a brand name, don't they? So I said, I agree, Tom. So that's why I called it that. And here's the business plan. This is the plan Bill Lipschutz and I put together. When Bill said to me, yeah, you should be looking to make over 100% per annum or more if you're willing to take more risk. And I said, Bill, no way. I was going to swear again. BS, Bill, I said. That can't be right. So let's look at that business plan, shall we? What he said is, work out what the maximum loss will be of your total capital on any one trade. What's the most you ever want to lose on any one trade? And he said, when you're proficient, and a business plan is about when you're proficient, when you eventually get to your destination. It's about the journey. It's not about today. It's about eventually. When you eventually get there, I want your stop loss, he said, to be 1% of your total capital. I said, well, what do you want my stop loss to be as a beginner? He said, oh, as little as possible. Don't risk more than say 0.5% of your total capital while you're learning. In fact, try and do trades on brokers which will allow you to do trades for 1 cent per point. Okay, 1 cent, sorry, 8 cents, 8 cents per point. And there are brokers out there. When I come to the brokerage bit, I'll tell you which ones and so on. We'll do that in an orderly fashion. So the maximum loss per trade should be 1% of your total capital. 1% of your total capital, fine. Total capital, he said, eventually you want to get to $20,000. Now, like I said, I didn't have that kind of money when I was a student. His point was, look, you need to know where you're going to get to and to see if the destination's worthwhile to decide whether or not to start the journey. So he said, imagine one day, surely, he said, Alpesh, you'll get to $20,000 under management one day. I said, yeah, that's fair enough. So let's say our total cap is $20,000. The maximum loss per trade would therefore be $200. Okay, because 1% of 20,000 is 200. The winning to losing trade ratio, well, given a coin is 50-50, right? Let's say we're only right 65 times out of 100 and wrong 35 times. So therefore, the average loss would be $200, as I said, and the average win would be $200. We're going to keep it simple. We're not going to have a reward ratio greater than a risk, anything like that. Okay, he said to me, no, just keep it really simple for now. Keep the math simple. Let's say you did 100 trades, 65 would be winning, like we said, at $200 profit. That's $13,000. 35 would be losing at $200, which is losses of $7,000. At which point I'm saying, Bill, I'm calling my parents. I'm too excited. I want to leave being a lawyer, and I want to do this for the rest of my life instead. Okay, no more cleaning toilets for me. Right, net profit is therefore $6,000 per 100 trades. One figure minus the other. $6,000 per 100 trades is the net profit, right? So I'm excited. I said, Bill, I've just got to keep on doing hundreds of trades and I'm just making money, like money for nothing. Okay. Okay. So he said, well, you need to find a strategy, therefore, to do 100 signals per day or per week. By the way, you don't have to do 0.5%. I've already shown you, as a private investor, you're more than happy, you're more than able to take more risk if you want. I'm just saying, while we're learning, we learn in the car park slowly. If we're willing to take more risk, then, hey, go on the freeway. I'm just saying you can do small sizes out there because there's brokers that let you, okay? Now, so I need to find those 100 signals. I said, Bill, I'm going to be a day trader. I'm going to sit in front of the computer all day long in my underpants and get fat and just trade and make money for nothing. It's going to be so easy, Bill. And he said, hang on, don't get excited. All right, let's do some maths. So we did some maths. I said, well, if I do 100 trades per week, I was getting really greedy at this stage. And there's 50 weeks in a year, has 5,000 trades per annum at $6,000 per 100 trades. That's $300,000 a year. Bill, tell my parents I'm leaving. And nobody, I guarantee you, no one's parents want to say their child is not a barrister or a lawyer, but instead is a trader. Can you imagine how embarrassed my parents would be? So Bill said, calm down. And I know what you're all thinking. Alpesh, what are you smoking? We're not going to do 90% of that. We're not going to be able to do 3/4, a 2/3, a half, or even a third or a quarter or a fifth of that. We're not even going to do 15% of that. But hang on. What if you only did 10% of that? If you did just 10% of that, that's still almost 3 times more than the $1,000 a month I said most people are targeting. So even if we decimate this business plan, we're still doing almost 3 times more than what the average person we said their goal is, which is $1,000 a month. So this is a good business plan, because not only do you do 10%, but even if you hit 4% of it, therefore, Bill said, look, this is therefore something you might want to look further into, because 4% of a business plan, if you achieve that, it's great. I mean, of course, ambitiously, we want to achieve 100% of it, but let's just be realistic and pessimistic and all the rest of it first. And of course, you don't have to do 100 signals, therefore. That's the beauty of it. You don't, because you're only looking to do 4% of it. All right, so instead of 100 trades per week, you could do, I don't know, maybe 5 a week. What's that? That's 1 a day. Remember the business plan earlier? I showed you 1 trade a day, 20 a month. Well, 20 a month would get us to almost 3 times our target of $1,000 a month. So I said to Bill, okay, well, wait a minute, sunshine, how come everybody isn't rich then? And Bill said to me, the 3 key reasons for failure: bad teachers, bad mentors, bad strategies. So let's go into the strategies part of this webinar now, okay? The most important part that I haven't yet addressed is strategies, okay? And then we'll come back to some of those trades that we've got at the moment. Again, by the way, in the course of this webinar, I just got to post it on my note from my assistant. We closed out on New Zealand dollar, Japanese yen. You can see we got the entry signal way too early. Nobody was at the office that early in the morning. So given that the entry signal was live and the price was still near the entry, we got onto this when we got into the office, and we've got an exit signal here. You can see the red cross. There's 2 ways of getting exited. Either you're watching the screen, in which case you just follow the crosses, or the trailing stop loss takes you out anyway, okay? And I'll come to some of that practicalities. There are only practicalities in a short while, okay? In a short while. What we want to know is those strategies, though, and then how those are depicted on screen and how you can copy them. So the way we trade and the way all those hedge funds I told you about, including AHL with its $19 billion trades, is momentum. What does that mean? Well, imagine you've got a big bank like Goldman Sachs who moves prices. They move prices. I don't move prices. I wish I did. I don't. Okay. Momentum is just simply saying that a trend is going to continue by observing what has just happened, or even better, looking at that part, looking at the finger, not looking at what's happened with the price. Our job is to try and look at this finger. Okay. And then what we're going to do is just ride on its coattails. We are not going to try and be a Goldman Sachs and stand in front of the trend and say, oh, this is what the Prime Minister is going to say, or this is what's going to happen. We're just going to ride on somebody else's coattails because we're making ample money doing that. Trend following is starting to buy there, starting to sell there. It works in what's called trending markets when they do this. Not so good when the markets go like that or fall. So we need to know, how often does it do this? And how often might we therefore not have a good time and maybe be losing money? Okay. Okay. And how often does it do this? And how do we make sure we get more into these than these? By the way, you're never going to not avoid these. Don't take my word for it. George Soros, in his book, Alchemy of Finance, in the back of his book, he has a trading diary. 40% of the time, he has this. That's George Soros, okay? I don't want you in this webinar ever to have to trust me for any information. I want you to know you can cross-reference it to the biggest traders in the world, and it's publicly available there through the biggest names, okay? Because how the hell do you think we got into the hedge fund business? We made sure we spoke to the biggest and the best and learned out what they were doing. We just copied what they were doing, okay? We just trend followed. We didn't invent hedge funds. We were trend following even in the business I got into, all right? So how do you then measure those trends? So Bill explained it to me. said how you measure strength and momentum is this. You measure how close to the high the price closes in that period, because that's trading psychology. You're getting trading psychology out of trading prices and depicting that. What is it? Well, what it's doing is, you remember those auctions you see on TV? Because I've got 40, anybody give me 60. I've got 60, anybody give me 80. I've got 80, anybody give me 90, so on. That's the price closing near the high, and that is psychology saying people want this. And we're not going to measure this by looking at the computer screen all day long. We're not going to, you know, we look to see, is it doing that? But how do we do it? And why does this tell us that the price is going to move? Like I said, it's trading psychology telling us there's a greater likelihood of the price moving out. Not a certainty. We don't have a crystal ball. The future is not pre-written, but a greater probability that it's going to move up. Why is there a greater probability? Because the psychology is already depicted, revealed in the price. The price is closed near the high. Somebody has, with their finger, flicked it. We also, how do we measure that? I'll tell you. We also measure increased momentum and decreasing. Why? Well, this. Prices, as you know, are a little bit like throwing a ball in the air. They go up and then they come down, they go up, they come down. Now, they're not exactly like throwing a ball, otherwise we could use calculus in order to work out exactly when to enter and when to exit. What we're trying to do is exactly the same though. And the way we find this out when momentum is accelerating and when it's decelerating is we just measure where it's closing near the high in each of those periods. But we get the computer to do it for us. And by the way, computers have been doing this for 30 years for people, okay? And the computers can do it for free on software that I've already showed you, which is free. What you don't need to know is the mathematical formula behind how you calculate where the price is closing, but I'll reveal it to you because you don't need to know how a car works to benefit from driving it. Okay, you don't need to know how that works for grandma to drive it. Similarly, just as you don't need to know how a car works in order to drive it, you don't need to know that's the mathematical formula for working out where the price is closing in relation to the high. You don't need to know that. You need to know it being depicted and telling you that's now happening. Okay, so how do we do that? Well, we do it by not just you relying on one method of measurement and not just relying on computers like I showed you earlier to do it. We look at multiple ways of measuring that. There's different ways of mathematically measuring that. So we look at what's called multiple indicators, which are freely available, so that we've got a greater likelihood of being right. But not just multiple indicators, okay? On that, so we've got a greater likelihood of being right. We also look at them in a way the textbooks don't, because obviously we've got some originality. We're not just copycats and trend followers. We look at the ways in which textbooks don't to make sure that we're getting it right, because if textbooks were getting it right, they'd be running hedge funds, wouldn't they? Right? And we don't just look to see, is it moving up in this particular time frame, whether that's the 1 hour bars or whatever, but the next one along, for instance, the 4 hour. And so on. We look at it in multiple time frames. Why? Because that increases the probability of a big move, increases the probability of a bigger move, and the probability of a move happening at all. Got it? It increases all those probabilities for us. So we look at multiple time frames and multiple indicators across those time frames. Okay. Now, how do we do all of that? How do we do it so that you can do it, so you're not paying every day, every week, every month for those kind of data? Like I said, multiple timeframes. Well, one of the indicators you've all heard of, most people will have heard of, which is freely available, called the MACD, but we don't use it in the way the textbooks do. We look to see, is it flat to rising in this, and like I said, multiple timeframes, the next time frame. So is it flat to rising? Because that's measuring where the price is closing near its high across the preceding periods. Okay, and we look at it across multiple time frames, multiple indicators, multiple time frames. Write that down. 1, multiple indicators. 2, multiple time frames. Okay, and how do we know, as John said, you know when to stop the car if various noises are coming out of the engine. How do we know when to stop this car? Well, when the momentum's run out and it's no longer flat to rising across multiple indicators on multiple time frames. Okay, that's when you know, ooh, it's spluttering a bit. Better get the hell out of it. Okay, yesterday's trade with CNBC, my assistant could have done with a simple moving average, because it was a simple trend that happened, which started at 5 a.m. I mean, you know, any monkey could have done yesterday's trade. So I don't want you to be impressed that CNBC said, wow, you called it right. It was one of the easier ones. okay, because it was a smooth trend. That's why it was easy, not because I'm some kind of rocket scientist. I'm not. Okay, so when I say, well, how do we know when the engine's making noises? Let me show you, to use John's analogy. You've got something like New Zealand dollar, US dollar. Yes, you know that the indicators, the MACD and the stochastic, multiple indicators across multiple timeframes, MACD2 means across the next time frame, are flat to rising. And when they're no longer doing that, the engine's spluttering, let's get out of there. You might not get out before the car blows up, but hey, that's fine. At least we got out, okay? That's the same analogy and principle. How do we know when to get out? And let's say you're not watching the screen, to use the same analogy. So you're not watching it. Well, you've got that stop loss that you started at the beginning is trailing. So by the time you're up here, that stop loss is here. And what about these additional positions? Well, you know when you enter the trade where the stop loss is, so you can tell the broker on your iPad, and you can tell them where you want to add the extra positions there, because they're already told, because there are multiple of the stop loss, but on the other side. So those are there, and their stop losses can be entered if you wish, or you can just say, I'll just take my profit there. If you take your profit there, guess what? You're foregoing all this extra profit. But the advantage is greater certainty, easier to get a winning trade. That's all. There's trade-offs on that. Okay. So what was the third thing then? Well, we also look for price confirmation. In other words, there's no point me getting into a trade if I'm the only one who's bloody seen it. I'm only copying a trend started by Goldman Sachs or whoever else moved the bloody market yesterday. I don't know who moved it. Okay, I'm just riding on their coattails. I was probably the last person to join anyway. Okay, I just joined it there. And then I told CNBC, and then they tweeted it, and then they watched me, and then they tweeted again. Oh, well done. Well, actually, like I said, the trend had already begun by somebody else. Okay. My point is this: we look for price confirmation. There's some price move, but without waiting too long, otherwise we're too bloody late. It was these three things, write it down: multiple indicators, multiple time frames, okay, and price confirmation, which literally led me to fame and fortune. Okay, I'll show you how to download that indicator. If you don't want to do it manually, and I've told you the rules manually: multiple indicators, multiple time frames, MACD, stochastic, flat to rising in this and the next time frame, and price confirmation. If you don't do it manually across that, I'll show you how you can download it. Literally led to fame and fortune. That's me developing it when I was at Oxford. Sorry, I look stupid with my white bow tie, my red carnation. Okay, I perfected the strategy. I then used it to win competitions, including in the Financial Times. That's me on the front cover of the business section of the FT, where over a 12-month period, I beat every other person they had in their competition, which, in case you're wondering, well, was that people who were crap? I'll show you who was on there, because it was billion-dollar fund managers as well. Okay, and the FT said, well, do you want to write books about how you're doing this? Because you're obviously bloody good. And I said, yeah, of course I want to write books about it. A, for ego, and B, because when you set up a hedge fund, having books gives you an advantage to raise more capital. Okay, so that was then the article, and there we go. There's the league table, and there's somebody I want you to see on there, not John Lee, who's now in the House of Lords, but Neil Woodford, who runs billions of dollars of assets under management. And over a 12-month period, he was wrong by about 25%. 25 bloody percent is how much he lost for his clients. I was out by 0.5% of the final value of the FTSE 100. It is not about what you know, because obviously you knew more than Neil. It's about who you know. Neil knew who would give him billions of assets under management. I didn't. Anyway, I am bitter. Yes. So the FT then said, well, would you like to write about this in a diary every week about your trades? And I said, yeah, absolutely. So did that, because I knew that would then help me set up the hedge fund. Merrill Lynch, HSBC paid me a fortune to get my research, which I then used. It was $1 million basically to set up the hedge fund. It's me with more hair, which is soon gone. We with my old style Bloomberg terminals. But it led to all of this, the Sky, the CNBC, and all the rest of it. That strategy, that was it. What we then made sure is we got computers to put all that in. So it told us there when the MACD is flat to rising in this and the next time frame, and there is price confirmation. Okay. Nothing's written in stone. You could enter a trade, it could go into a losing bit and then move up. But this helped remove our stresses, because we knew exactly where the stop loss was, because it was based on volatility. And we knew the further away the stop loss, put less money into the trade. And we knew where, if we wanted to be really cautious, the profit target was, or even better, where we add equal and same position size. What we quickly realized is without an indicator, this is what trading is like. You're trying to pick up one piece of corn at a time because you're having to do it all manually. Okay, and that's fine. Do it manually if you want. If, like these people, you haven't got the money, okay, and you haven't got the skill, you haven't got the know-how to buy a combine harvester, do it manually. Without an indicator, do that. But I can tell you which way the industry is going. The whole asset management world is going. It is going down the route of having, just like with cars, we have automatic cars. Okay, they help with the power steering. You're still driving. You still decide when to place a trade, but at least the car's automatic. Okay, and it makes it a bit easier than a manual car. But you can still drive manual cars if you wish, if you're old-fashioned. But we wanted to know, can people actually do this? Okay, not to be replaced by robots, but actually use the indications that, like we've shown you, so that can they actually do it? There's no point giving people the technology which they can't handle. No point putting an untrained person into a space shuttle or a car without driving lessons and then they crash it, to use that analogy. Will they be able to actually do it, or is it just still too complicated? Okay. And so what we did is we gave groups of them to see if humans can use indicators. And what we found before indicators and after indicators, that after an indicator like that, they had greater confidence in a strategy because you had it there in front of you. So there was less stress over losses. Okay. They felt they had a business plan, because they did, for their profits, their longer term profits. Okay, that went up. I mean, these are just emotional responses, you could argue. Clarity of exits, they had clarity of entries, clarity of stop losses, but that's how we removed that emotional problem. Okay, so that's why I'm suggesting and telling you what strategy you should use in this webinar, i.e. volatility-based stop losses, okay, volatility-based position sizing, okay, momentum trend based, because I've shown you why and how, multiple indicators, MACD, stochastic, across multiple timeframes, and price confirmation. You got all of that. Now, I did say to you right at the start, give me 10 minutes at the end before we do the Q&A. Before we do the Q&A, give me 10 minutes to tell you how my hedge fund is building and changing the financial technology world upon its head, how we are turning it around. I said to my team, I want to create the Google of trading. Why? Because technology companies are becoming billion-dollar companies. Hedge fund manager called Jeff Bezos set up Amazon and showed hedge fund managers can create technology companies. So I said to my team, and we called it Project Pips Predator, buy when the price goes above the horizontal line, because that confirms there's price momentum across multiple indicators, MACD, stochastic, in the next time frame, multiple time frames, and price confirmation. Okay, and therefore we can amply look at and scan 12, 16 screens, even more, and within 15 minutes, by saving our time, work all of that out. Do you see? That was then critical for us. It was critical to be able to do it that way, because without that automation, we don't have a blasted combine harvester. Okay, and we wanted to make sure we got a combine harvester. We're not messing around. We want to make that money as soon as possible. Then we analyzed which timeframes were best for us. Okay, the time frame we found the best was the 1 hour time frame. How did we find that was the best time frame? Because typically it was giving us about 25 trades in a month. Okay, some maybe we were taking 28. This is how many we were taking, not back testing, where 3 in the morning apparently is supposed to place a trade. That's bullshit. Nobody places trades at 3 in the morning. Okay, and some months it might be as little as 18. Doesn't matter. 25 on average, which was capturing 2,250 pips on average. Now, wait a minute. Some months you might get more, like Brexit or Donald Trump, 4,000 pips. And some months, like August, you might get none. Yeah. Yeah, absolutely. But guess what? When you get good months, you take the excess capital and keep it for the bad months. And therefore, ironed out was coming to about 2,250 pips. The best winning streak, was 70 wins out of 100, 30 losses out of 100. The worst was the other way around. That doesn't matter. You'll see why win-loss ratios don't matter. What matters is this figure. Net pips captured, 2,250. Before we got a stop loss, i.e. before the engine would splutter and we'd say, right, got to exit now because the momentum's run out, typical max loss in pips was 50. Now imagine you're doing $2 a pip. 2 times 50 is still a lot. It's $100 is the loss you're suffering. But wait on, $2 times 2,250 in a month means you're making $4,500 on the 1 hour time frame each month, which was a better and more lucrative time frame than the 30-minute bars or the 4-hour. But wait a minute. $4,500 a month is 10 times more than the $500 a month I said we're targeting, or 500 to 1,000 we're targeting for most people. I only want people targeting 500 a month initially, not trying to run, not get greedy. Greed is what will kill you in the markets. 500 a month. Well, that means we don't need to do $2 a point. We can do 20 cents a point instead. That made it more realistic for private investors. That's why, like Google, it can be more realistic, more applicable for private investors. That's how it came about. That all these figures, we have to make sure everything works in synchronicity for private investors. So let me show you some more trades. But can it make money? Well, I think I've shown that, but I'll show you some more trades. Is it easy? Well, I'll show you how our apprentices handled it. Can you do it any time with a day job? Yes, the whole idea behind it. And with trading is I've got a day job. I've got to go raise capital for my fund all the time. I've got meetings with institutions. Does it make life easier? Hell yes, because you're following buy signals, placing the trades, and that's it. Not Fibonacci, not Elliott, not any of those things. So their checklist, I'll give you the same checklist I give our trainee hedge fund managers when they're starting out, because when they start out, they're only in their early 20s and they don't know anything about the markets or trading either. This is a trade example from an apprentice. Full disclosure, not one of my trades. One of the ones my apprentices did. He happens to like euro dollar 5-minute bars. So this is one of theirs. Okay, 5-minute bars. There we go. Euro dollar 5-minute bars, 3 hours, 75 pips, including additional positions. 75 times $30 a pip, $2,250. Okay, now why $30 a pip? Because once they're consistently profitable, they're going to do bigger size trades. Full disclosure, another student, not me, that I'm mentoring, euro dollar 15-minute bars, 9 hours, 73 pips, including additional positions. Not all trades are winning. I told you we're not even looking to do that. I'll show you a typical month in a second. Okay, win, exit. Some are small wins. Okay, only 20% of the time will you have big wins. The rest of the time you've got small wins, small losses. Okay, that's it, right? 20% of the time you have big wins. Rest of the time, you've got small wins and small losses. Small wins cancel out the small losses. The 20% of the time you get the big wins is what makes sure your profits at the end of the year. That's how it works out, not just with us, but with any professional trader. That's how life works out. Typically, this is what will happen. Like I said, they're not all win by any means. You get your wins, okay? Some are big, some are small. Of course, I wish I could just pick the top and sell and just get out at the bottom. Life isn't like that. Real trading isn't like that. We don't have a crystal ball. Nobody does. Okay. And like I said, some are losing trades. Yeah, that's reality. But any good strategy should make sure all losses are, and I want you to note this really carefully, small in size, short in duration. Small in size, short in duration. Small in size, short in duration. All winning strategies should have losses which are small in size, short in duration. That's the saving grace. How do you verify that a strategy is any good? Well, you make sure this is what's said of it. This is what the chairman of the Chicago Board of Trade, the world's largest exchange, said of mine. You make sure they say it in print, not Mrs. Jones from Croydon or some actor on the video screen pretending that they understand the strategy. I'm talking about somebody who's got a reputation to lose, who writes it in print next to the Financial Times, so they know they've got to get it right. This is what Pat Arbor said of my strategy. Gets to the heart of the matter of trading by clearly elucidating the methodologies of successful trading strategies while capturing the ethos of successful traders. So who's my most successful ever student? I'll show you how to download it in a minute, Jim, and Michael and several of you. Don't worry, don't worry. This is my most ever successful student, Naomi Wastel. She now works at Newton Investment Management, and she manages, I think it's about $10 billion. I hope all of you will do better than I do and manage more assets than I do, but she manages 10 billion. You might say, well, wait a minute, how do we know she wasn't working for you when she was already from Goldman Sachs? She used to be my secretary. Mine was the first job she ever had. When I tell people this, they go, bloody hell, you must be good. I said, well, they don't all turn out like this. By the way, when I tell you about students, I don't tell you some random member who goes, oh, yes, I'm a member from Croydon. I'm an actor, really, but I'm going to tell you how good Alpesh is. No, I show you people who go on to become from secretaries to fund managers. Well, it's what you'd expect. I did, when I started all of this, start off talking to the world's leading traders. You know, it's how the whole journey started. I want to take people from this to this, this to this. basically. This is what trading is like for too many people. Without an indicator, this is ancient. People doing volume analysis, Fibonacci, Elliott waves, forget it. An indicator should tell you across multiple indicators and multiple time frames and price confirmation what the market's doing. This is my favorite student. He used to work at Barclays. You can call it Barclays in London, at Canary Wharf, and say, did you used to have a Biku Alawelia? Left school at 16. This is what he says. I love the pipspredator. I now spend most of my time trading, and I love that as a novice. I know what to trade, when, how much, can leave the exit price and get on with my other work. Yeah, that's what you'd expect. What I like to do with people is we wanted to create the Google of trading. So we wanted to create this technology, make it available to people, make sure they test it, make them profitable, and then spin that technology company off as a Google, maybe even IPO it in 5 years. Okay, spin it off as a Google, get venture capital investors into it, potentially get them in. And to give people not just the technology, but give them hand-holding, mentor them for life. Because somebody said, how can you prove to people that you're the real deal other than showing them, look, I've got an audience of 75 million, so obviously I'm the real deal because I don't want to risk my reputational damage. I'm going to use that profile to promote the financial technology around the world and turn it into Google. Wouldn't you do the same if you got an audience of 75 million? Hell yes, you would. You'd create the financial technology and do an Amazon. And I said, the other way to prove that I'm the real deal is this. I'll give them lifetime mentoring. They don't have to pay every day, every week, every month, every year, or even when they use it. They don't have to pay for the mentoring. As well as the indicator, I'll give them email access to me, videos. So they've got bite-sized videos from me on how to trade and all of this. So if they need it, they can do it. A dedicated mentoring website where they see lots of articles by me on every single bit of it. A 30-day mentoring course. They can use it for life. I just think it takes 30 days to do. That's all. Or a 12-week more extended one, which I think takes 12 weeks, but you can do it, for the rest of your life if you want. I'm here for you always. And a trading manual and articles, and get them to fill in mentoring questionnaires so I can monitor how they're doing every fortnight before they start and everything else. And they get to keep my 2 most recent books as well. So I take them through the business plan on the mentoring practice. They do all from the comfort of their own home, give them exams, track their progress, benchmark them for the rest of their lives. Why would I do it for the rest of my life? Give free, basically, mentoring for the rest of my life? Well, because when you know you've got the real deal, when you know you're the real deal, you know you're not going to be bugging me because you're going to be too busy trading. Why would you bother me if you're making money? The only people who would ever bother me are ones who aren't doing it, and I'm more than happy. You get those driving lessons where it says, if you don't pass first time, free lessons until you pass. That's what it is. Hey, if you don't get to profitability, you got me for the rest of your life. I take on people, and I use this idea. I stole this idea from Lord Sugar in London, who takes on apprentices, and he's a billionaire. I thought, take on apprentices, and I give them my personal guarantee with this technology, my personal 30-day, no quibble guarantee. You don't have to do any trades if you don't want. You get to keep both of my 2 most recent books just for doing me the honor of trying this. So total guarantee. Not 7 days, not 14, not 21. 30 days, I think, is ample time to learn and practice and see that you're going to make money. 100% money back guarantee and no quibble. You don't have to give me any reason for it. Okay, you can download it instantly. It takes about 10 minutes to install. If it takes longer, we'll install it for you on Mac and PC. I'll also send you a USB with my 2 books, which has got lots of reading material, as well as obviously the mentoring site you can have access to immediately, and access to my online 30-day course, which is a sort of online boot camp for traders and investors. The snag is I only take on 25 at a time. Why? Well, to ensure high quality, manageable mentoring from me, obviously. Okay. My job is to take on 25 at a time. I have about 100 going through the program, but I only get about 3 emails in a day because they're busy doing things. Okay. And when they graduate, they're consistently profitable. And I take on batches of 25 at any given time. Okay. That's what I do. If you want to be part of this, I highly recommend it. You want to instantly download the indicator, start trading this afternoon. The markets are open. Okay. Join basically my personal trader mentoring apprentice club. Okay. That's the URL. There is no upsell. There's no monthly fees, no daily, weekly fees. All the live real-time data is free for life anyway from the platforms. It is a one-off fee. If you're in the EU, there is VAT. If you're in the EU, if you're outside the EU, there isn't VAT. It's as simple as that. Okay. And you can download it immediately and start trading and get all that mentoring. Let me show you, my friends, let me show you how we mentor and train our own traders, because we do it the same way with you guys as well. And then you install the indicator. You know, look, it sits down here. You install it, you drag and drop it onto the screen. I won't do it because it's already in there. And then that's it. And you're off to the races. And you're off to the races and placing the trade. This one's on. By the way, we're still long on this Australian dollar, Canadian dollar, 15-minute bars. We are still long on that trade. If anybody wants to know the ongoing trading positions. So like I said, what you do, and I want to create this into $1 billion tech company. How can I do it? Well, when we get venture capital investment, we're going to get expanded around the world. You guys will always have me as your mentor. When we expand it out, there'll be other teachers and mentors, but you will always have me. Okay, I will always be your mentor for life. In future, next month, the idea is to make it £2,000 a month. Sorry, £2,000 a year for the indicator, £2,000 a year for the mentoring. Not for you guys, it's a one-off fixed fee for you guys. Okay, it's fixed one-off. Does work on Mac, Michael. Does work on, as well as Mac, does work on Windows. I use it on both types of computers, so don't worry about that. Okay, you do have, I'll show you the bite-size mentoring and the videos and the hand-holding. You've got direct access to me anyway via email in case some of that doesn't, any of it doesn't make sense at any point. You've got me. It will be £2,000 annually for the indicator and £2,000 a year for the mentoring. But for the moment, it's this because I'm building up that base to show the venture capitalists that we are onto something bloody huge here. Okay, something absolutely huge here. As John Watson, co-chairman of CNBC Arabia, said, the lid of the trader's black box has been well and truly removed. Thank you, John. Yes, it has, as well as a whole load of other people from Coots and everything else. Okay, about my trading and how I do things. All right, so I've got credentials from Schwab, TD Waterhouse, Barclays, and that's it. If you had the same credentials, would you not want to create a fintech or financial technology company to do exactly this and get to your magic billion? If you're not going to get $1 billion under management because Goldman Sachs are taking it all in competition, you'd create the technology company alongside it and do what Jeff Bezos did as a hedge fund manager and set up Amazon. Okay, it's the equivalent of Amazon to me. So what does the mentoring site look like on there? The mentoring looks like this. Okay, there's a dedicated website with a 12-week course on it. You don't have to take 12 weeks. You can do the rest of your life. But the most important part of it is that when you scroll right down to the bottom, you've got loads of testimonials from people using it, and actually there's 100 more to put on there. You get my emails and all the rest of it. You get mentoring emails. You don't have to look at them every day if you don't want. Just put them in your folder and look at them whenever you want. You've got me for life. Don't have to rush it. You've got Skype numbers, a 24-hour live number where an assistant of mine can get hold of me at any point. And she'll find me wherever I am, as well as normal Skype numbers, Hong Kong numbers, US numbers, because we've got a lot of people in Hong Kong. And I'm going to be in Singapore in March. If you want to meet me in London in February, I'm going to be at a conference, Forex show. So you can meet me then. Come to my office on Brook Street, where I am, and come and have a chat, have a coffee, or whatever else. Okay. Also, if you're an apprentice, connect up with me, because I'm going to give you all a certificate of completion when you completed my course as an apprentice. You can put it on your CV if this wants to be a career change for you. And link up with me on LinkedIn, which is free, if only if you're an apprentice, and I will introduce you to anybody you want through LinkedIn and so on and so forth. That's me on LinkedIn, and you can also see that in The Real Deal on there, because you'll see all my networks, and there's no way you're networked to some of the people that I'm connected to at the banks and in government if you're not The Real Deal, if you see what I mean. Okay, so I want to use all those credentials, those networks, to get this technology company to be basically the best at what it does in the world. And my background is what leads me to want to do it. Like I said, the 12-week course, you have got not just the indicator you download, but you've got this bit by bit, bite size, each week, bite size, a little bit, so you never get overwhelmed. Now, some people love this. Others never want any education. They just want the indicator. They want to start trading this afternoon. They want to start making the money. All right, and that's fine. But remember, you've got to go. So, oh, by the way, just very quickly, the sterling yen 5-minute bar, we've got a signal on that. Sorry, I didn't tell you earlier. I got the Post-it stuck on my forehead, basically, because I ignored it on my desk. Sterling yen from my assistant. Thank you very much. There we go. We're long on that at the moment. So, and it went straight into the money because obviously the trend is in place. So this is where we are on that. And that's what I want people to start doing. I want them to start trading. I don't want them to start trading loads of money. I don't want them to go out and say, oh, I'm going to mortgage my house. I want you to watch it first, trade at the smallest size. Okay, first of all, I promised everybody who stayed on the webinar they'd get 2 trading ebooks. Everybody on the webinar is going to get those. Check your inbox in about 10 minutes. Check your inbox in your spam folder for those, and the names of the brokers that I particularly like who are quoted on the stock market, so they're big and they're FCA and SEC regulated. You'll have that in your inbox as well in 10 minutes, okay? Because we know who stayed to the end, and we only want to reward people who stay to the end. If they can't be bothered staying to the end, why should they be given any reward whatsoever? Oh, by the way, as you sign up, no, I don't fire students, John. What I do is I stick with them forever. It's a brilliant question, John, okay? Also, so I want people to know, John, that I'm with them no matter what, okay? Whatever happens. I want them to learn. And by the way, it might not be just this kind of methodology. It could be anything they want to ask me about trading. When you've written 18 books about trading, you pretty much know every area, every technique, errors, mistakes, and all the rest of it, okay? I actually started off, remember, as a private investor before we set up the fund 10 years ago. I started off as a private investor. You know, when I was writing the diary of an internet trader in the Financial Times, that's me as a private investor. So I understand what their problems are. But being an institutional trader, I understand the technologies that are available. And it just made so much sense to take the technology from my industry and apply it to the private investor, just like Google guys did a PhD and then made it something which, you know, your grandmother can use Google. That was the point. You hide the complexity. Hide the complexity is the secret of success. You make things as simple as possible. Let me tell you 3 ways in which we accelerate people's learnings. 1, every Saturday, I do 6 webinars. Okay, every Saturday for apprentices. 11 a.m. on stop losses, 12 o'clock on entries, 1 o'clock on limit orders or taking profits, 2 o'clock on trading psychology, 3 o'clock on money management, 4 o'clock on adding to winning positions, right? That accelerates people's learning because they've always got that contact with me, as well as emailing me any trades that they've done and questions that they might have. Every apprentice also has a trading questionnaire they fill in at the start, so I can make everything bespoke to them. So I can tell them, you got a problem with losses. You got a problem with discipline. Look at this bit. Look at this video that I've done. Look at this, and then let's talk. Okay, so they've always got that education. They fill that in first. It's not the only question they fill in. Every fortnight, I ask them, they don't have to do it. I'm not a school teacher, to fill in a mentoring questionnaire every fortnight, just so I know how they're doing. This then through Google Forms comes onto my cell phone or my laptop, wherever I am, so I can look for any discrepancies, so I can see which students are falling behind, okay, who's not keeping up to pace. Now, obviously, if you don't fill it in, that's entirely up to you because you're happy being profitable. It's not the way you like to learn. That's fine. Okay, I'm just saying that the options are there, but we do something else. Not only the questionnaires to make it bespoke, not just the webinars and obviously the email contact with me and everything else. You have a bunch of cheat sheets that I give you on here. And these cheat sheets just show you everything that I've said. So you can at 3 in the morning learn at the comfort of your own home. You're not going to a hotel. You're not doing a conference. You're not going to a course. Nothing like that. Okay. And by the way, put your names in. Okay, Tushar, I teach that. I love that. As a beginner, I'd like to know the proper business plan and how to fix up a stop loss. Exactly. Some people have got certain things that they need to know other than others. One size doesn't fit all. That's why I ask all of the students, Tushar, yourself included as an apprentice, to do this, to fill the questionnaire in so I can see, you need this help, you need that. And also, there's things you've not even thought of that you didn't know you needed help with, and we help with those. Okay. Then you've got all of this. So the reason for this is, in a classroom of 30 people, you can't do this. You need to do it in the comfort of your own home at a time to suit you without paying for hotel and travel costs. But the advantage for me is it means my technology becomes more successful, because if you've got all this support, you're more quickly going to get to profitability. As you get to profitability, the valuation of my company goes up. So when we float it or go to a venture capitalist, it's at a higher valuation. Okay, so I'm leveraging private investors, just like Google leveraged the people who use their product to float it for billions. I'm just doing the same thing, leveraging private investors by creating something they want, they need, they didn't even realize they needed, they didn't know it existed. By doing that, we're just using exactly the same shrewd, clever little strategy, which is what you'd expect, to take from what we know in the hedge fund, use it outside of an institutional basis for a private investor base, where, like a Google or a Facebook or anybody else, it should be a big financial offering, something which changes the shape of how finance is done in the world. That is the ambition. Okay, it's as simple as that. What I'd say the starting steps are, if people were to ask me, okay, well, where do we start from? The starting steps, well, in a way, whoops, let me just move all this out of the way. Yes, Michael, it does work on Mac. No, there are no upsells. The data is live and free forever because that software is freely available for many brokers. We're just going to add the indicator onto it. Okay, you can use it alongside NinjaTrader or anything else. You can use it with any broker you want. If you're happy with a broker, that's fine. Okay. Delighted, Roger. I'm delighted. Thank you very much. It's always good to hear, and I always want people through these webinars to be motivated, and I want them to know we're going to get there always. And by the way, we even through these things. Remember, we listen to what people say, and people said to us, "Look, we want to know. We want you to spell out the buy price, the stop loss, where we add to the new position, or if you don't want to add because you're a beginner, just take profits at that position, where the stop loss numbers are. And let's say we wanted to do $100 maximum loss. Maximum loss of $100, do one lot or $7.88 per pip, because if it then hits your stop loss, you'll have lost $100. You might say, I don't want to do $100 loss. I want to do $10. Fine, divide that by 10 and do 78 cents. So it's all calculated for you. Of course it should be. And that actually came from students. Students said, we want that. We went, okay, fine. And then these stochastic MACD, MACD2 sort of traffic light indicators, because they wanted to know, okay, we want a flavor of how things are moving at any one time. It doesn't mean you only buy when all three are up. You buy when that green arrow is up. This just is like traffic lights, tells you, okay, how the trade is looking in terms of speed. It's like a speedometer. It doesn't mean you stop just because they're not all pointing in the same direction, okay? And when they are pointing in the same direction, you know you're going to have a stronger trade. Let's see which ones are pointing in the stronger direction at the moment here. This one down here, which was sterling yen, look, you can see straight out of the gate, and we're in profit with it. It's already at our add profit level, okay? So we double up our position here. Just give me 1 second, guys. Just wanted to make sure my assistant's seen that, and we've added the position on that, and she has, and we have, so that's good. So you guys are lucky for me. We're making profits, which is what I want to see, okay, when these things happen. On that, guys, I also want to know, all stops are trailing, yes. Oh, Michael, write this down. I might not have time to explain it in great detail. Actually, I will, because I'm going to show you. Not only trailing stops, but ideally, I want them to be what's called fixed trailing stops. What that, or stepped, some brokers call them steps, not dynamic. Dynamic's good. If you can't do fixed, do dynamic. Nothing wrong with that. Now, the difference between that is it means there's more room for maneuver for your price to go up and then down and then back up. With a dynamic trailing stop, it tracks your price pip by pip. With a fixed one, it only moves up if the price has already moved up, say, by 20 points. So what happens with the dynamic is if it goes up 20 and then down 20, it might hit your stop loss. Whereas with a fixed one, if it goes up 19 and then down 19, it won't hit the stop loss. And then if it goes back up, it gives you more room for maneuver. It gives you more room for maneuver. I explain all of this in the mentoring anyway. Okay, and I'll show you an image of that in a second, Michael, on that question. 6 simple steps then to becoming a trader. First of all, watch the webinar while you've done that. So you got one out of the way. Download the indicator. It takes 10 minutes to install. It takes longer. Let us know. We'll install it remotely over the phone. Okay, there you see. Step 3. Step 4, follow the signals. Okay, follow the signals. How many signals do you need to follow? 1 a day, I'd say. You can do more if you want. I'm giving you the bare minimum. Okay, find any broker you're happy with. We'll give you recommended names that we like. But if you're happy with one, that's fine as well. Finally, use my mentoring, get trading, and that's it. What I should say is, I'd say about, well, first of all, we're going to be friends for life, my friends, okay, whether you like it or not. I'd say indicator and mentoring split up like this. I'd say there's a whole group of people who only use the indicator, a whole group who only use mentoring, and in the between, there's the ones who use both. Okay, what does it look like? I'd probably say in the first week, we'll probably lose about 1 person a week on a worst case scenario who says trading's not for them. Okay, worst case, that's what happens. Profitability starts off like some will be instantly profitable because they're experienced traders. Some who've never traded before are total beginners. Obviously, it's going to take them longer. It might take them 3 months. Worst case, that's the worst case we've seen. 12 weeks sort of to get right up there because they're busy or they're total beginners. About a fifth of them download it and are starting straight away because they already know how to do all of it. You know, simple as that. So like I said, that's where you go. Let me just show you about those stop losses, Michael. Stop losses. Discretionary are better. Absolutely. I'll tell you what's even better than that, John. You should use a blind agency broker. If you use a blind agency broker, it doesn't matter that the stop loss is in the market. Let me explain blind agency brokers, okay? And let me explain these types of stop losses. If you've got a stop loss which is fixed, the advantage is it's simple. Obviously, the disadvantage is the loss could be bigger because the market could go up and then all the way down to your fixed stop loss. And a beginner might want to do that, and that's fine. Okay, if you've got a trailing stop loss which moves up at fixed instruments, so imagine that's the stop loss and that's where you bought and that's your profit target for argument's sake, the advantage is it leaves more room for the price to move up and down before hitting the profit target, so more likely to hit the profit target. The disadvantage is the loss could be bigger than it need be if it had been a dynamic stop loss. What I mean is, if it goes up here, and this stop loss is going to stay the same, isn't it? It's not going to move because it hasn't moved this distance up here, which is what it needs to do before the stop loss moves. So it can go back down again, then up. Whereas with a dynamic trailing stop loss, leaves less room for prices to move up and then down before hitting the profit target, so less chance it will hit your profit target, but your losses are smaller. In other words, if it did this, then did this, it would hit your stop loss because the stop loss will have moved up pip by pip with the price. So if afterwards it was and could have done this, you'll have missed out on that profit. Okay, so there's disadvantages and advantages to each. On balance, we like the trailing fixed increments stop loss. There's a lot I've just told you, okay? There's a lot I've told you to take in. Don't worry about it. I just wanted to make sure that you know this is the level at which we can mentor you if you want. You don't need to know any of this. You can just drive the car if you want. You don't need to know why. I'm just explaining how the engine works, okay? I said right at the start, I'd also tell you a little bit about how brokers, let's deal with brokers, okay? How we sued a major British broker. We sued them for £90 million. It was in the FT, okay? We sued them there. The plaintiff was a friend of mine, Raj Gill. I was the expert witness in the case who proved in court that momentum or trend following strategies work. I might be the only person in the history of the world who's proven in court that a trend following strategy works, okay? We won only 20 million, not the full 90. Hey, 20 million, I'll take it anyway. We asked for a lot more. And that's Raj there. That's me with Raj in Vegas. We did party afterwards like crazy. Anyway, the point, and I'm teetotal, so it was still a great party. My point is this. I'm willing to go up against brokers. I'll do whatever it takes. I hate brokers, okay? Because I think they're trying to rip you off. The reason I prefer blind agency brokers is this. A blind agency broker matches buyers and sellers a bit like an estate agent, whereas most brokers nowadays have become like casinos where they bet against you. Why do they bet against you? Because they know 90% of clients lose money, so they'll bet against you. 10% make money, so the broker knows it's a one-way bet for them, right? So why do I prefer blind agency brokers? Because they match buyers and sellers. They can't know whether you're buying or selling when they quote you a price, and because they're matching buyers and sellers, they've got no skin in the game to move the market against you, move the prices against you, do all sorts of dirty little tricks. I've emailed all of you. It should be in your inbox already. 3 brokers that I particularly like. Whichever brokers you use, please ask them if they're blind agency. They might, no, we're not, but we're so much better than that, or whatever. Just be careful. Never trust a broker which is regulated out of Cyprus because they're not a proper regulator yet. Never, oh, by the way, Raj was called the 7K to 7 million man because he used those momentum trade strategies, which I in court testified on, to go from £7,000 to 7 million. You can Google it. They called him the 7x7 man. They never really did, you know, just journalists made it up. They just completely made it up. They said, oh, we're going to call him the 7x7 man. I mean, he did make 7 million from 7,000. That's why he got the 20 million payout. But nobody called him that. Just journalists made it up. They call him in the city this. And trust me, he's one of my closest friends. Nobody, you know, newspapers, they just made up that name for him. Anyway, because of how much he made. He actually made more than 7. He actually was pissed off because he said, they should call me the 7x14 man or whatever. Anyway. The other point is this. Don't trust binary options, please. Don't trust binary options. And the reason for that is binary options or binary options trading has embedded options within the prices are too skewed out of your favor. You're just not likely to make any money, and they're usually run by brokers regulated out of Cyprus who are going to con the crap out of you. Okay, Surinder, if there's anything available, yes, I can hold one for you for a day if you wish. Let me know. I'm happy to hold a position, one apprenticeship for you if you need a day. That's fine, and hold it at this price as well. Don't forget, it's a 30-day money-back guarantee anyway. No quibble. And the reason, and I don't want people to think I'm a narcissist. Somebody accused me of being a narcissist because I showed pictures of me with famous people. Anyway, the reason I was actually doing it is to give people a trust assurance that if you're not happy, given I've got a massive audience, I don't need to damage my reputation by making anybody unhappy. I need everybody to be happy. That's why it's a no quibble money back guarantee. Okay. I need everybody to be happy because my ambitions are far bigger than just 25 apprentices. My ambitions for you are you all become profitable in your group, which as Edge group gets profitable and profitable. The only one thing I ask of all my apprentices is this. You're not obliged, but what I say is this. When we are fundraising from Sequoia Capital, Google Ventures, or Amadeus, or whoever it is, that you give a testimonial, an honest one, okay, so that the venture capitalists can see how much this is worthwhile, okay, as well. Brilliant, John. The FCA are bringing out new legislation for binary options. Not quite accurate. FCA cannot bring out legislation. I am consulting to the FCA and providing my advice that binary options should be outlawed. It's Parliament which will bring out the legislation. The FCA can give recommendations and regulations. I want the FCA to put regulations in place which will absolutely make binary options illegal, because I think they should. I think they should also ban leveraged trading. I think all trading, including in Forex, should be unleveraged. Now, you might say, well, wait a minute, that means people are going to make less money. No, it means people might have to work a bit harder to make their money, but it means they won't be losing more money. That's why. And I'd rather protect them from their losses, because I can tell you, when you're writing in the Financial Times, you literally get the proverbial widow saying to you, oh, I lost all my money with some shitty broker. Okay, and you cannot imagine how annoyed and angry I get at the broker. So I'd write to them and say, hey, listen, I write for the FT. I'm going to make you famous, Mr. Broker. I'm going to make you I haven't given shout outs to people. I've got names on my list. Virendra, congratulations to you. Sunil, Michael, Brian as well. Congratulations. Thank you very much for joining up as well. I think we've got a couple left. Oh, if you're having problems, it means all the licenses have gone. So if you can't log in on alpeshpatel.com/, I'm afraid it means that the licenses have gone, I'm afraid. So sorry about that. Try the PayPal link if you've got any problems. But that's probably what it means. Listen, guys, I'm going to have to go and deal with my apprentices. Apprentices, I'm looking forward to speaking with you and making sure you don't end up like that poor guy who's been on my screen since the morning. He's not somebody I know, by the way. He's not an apprentice. He's not someone I know, but that's how most people start off trading, and I did as well, like I said. Listen, I hope you've enjoyed it. I hope you've got tons and tons of valuable information off the back of what I said. Michael, CFDs are perfectly fine. I mean, the cash market's fine. CFDs, you just got to be careful with the brokers, and I email you the brokers that I think are okay. Well, I know are okay, because I have 3 rules for brokers. Have I met the CEO? Have I been to their offices? Okay, and are they regulated by 2 institutions, either the SEC or the SEC or the FCA, and a stock market like the New York Stock Exchange or the London Stock Exchange. So they've got the regulatory cover, and that they're too scared to mess people around. Okay, so I want you to know that as well. On all of that, I'm just going to look at some of the final bit of trades while people send in the questions and just see what's happened. We've got another one on sterling Canadian dollar, which has just come in as a sell. Ugh. Oh, sorry, wait a minute, you can't see it until I do that. Let's share that. There we go. Sterling Canadian dollar, 30-minute bars. We've just got a sell signal on it there. You can see all 3 arrows are pointing down as well, which is always a good sign. I know what the stop loss is there. That's my profit target, or my add to profits target, that one. So we think that might retrace the whole way through. It's Canadian dollar, sterling, 30-minute bar. So let's just watch what happens with that. Okay, and that's it. And like I said, we have this big gain over here, so I'm happy anyway. And sometimes, yeah, we might have losing trades. Doesn't matter. Small in size, short in duration. Overall, we're making money, and that is what matters for us. Okay, so I think hopefully you saw all of that. Listen, guys, I want to thank you all. I hope you enjoyed the webinar. If you did, please let me know that you enjoyed it, because it helps my feelings. Okay, and hope you, like I said, did enjoy it and found it useful as well. Any other questions? I'll keep the chat box on, so let me know and I'll answer them offline, but I'm just going to go to the apprentices and answer any questions that they have. Michael, thank you very much. I really appreciate that. I do appreciate when people do take a second out and let me know if there's any ways of improving the presentation, anything you want to see differently, then I do appreciate it. I do like your feedback. Thank you all very much for listening.